Goldman Sachs coming into 2021 looking for 4,300 year end, 4,100 right now on the S&P. You mentioned Morgan Stanley, Tom. Execution risk, execution risk. Will the quarterly earnings be about the outlook, the better earnings that many people expect, or will it be about the outlook around supply costs, input prices, labor costs, margins, Tom?
It's going to be about listening to the conference calls. And I can say in ages, John, the conference calls are more important than they've ever been. What is the guidance for it? And again, linking into inflation on the cost pressures that Michael Wilson at Morgan Stanley speaks of.
I know we usually do this, big week ahead, but seriously, big week ahead, and very happy to say back in the seat, Lisa Abramowitz. Lisa, Powell on script, coming into a significant week with inflation, retail sales and earnings on deck.
Yeah, although he really has a very narrow window here. Basically, we're going to be getting better and better economic data, better inflation reads or worse, depending on whether you're actually paying for higher prices. At what point in the year, and John, you've been really good about this, later in the year, June, July, August, those year-over-year comps get a little more complicated and they have to start taking care a little bit more. People already projecting out, though, a 2023 that is much better. How does Powell deal with that?
Can we get to 23 this week? Got to look at this year ahead. Really complicated week ahead for us all to process a lot of economic data. Let's whip through the price action. Just to begin and kick things off this Monday morning. Good morning to you all. The S&P 500, 3 straight weeks of gains, 4,100 all-time highs on the S&P coming into Monday morning. Futures down just a touch, -0.2%. In the bond market, Lisa will run you through the supply coming through today, through this week in just a moment. 165 on 10s right now. Yields basically unchanged. And in the FX market, the vaccinations in America, tremendous. I'll go through the numbers a little bit later this hour. In Europe, they improve. Euro dollar, Lisa, a 119 handle.
Well, and actually the European improvement, I think, is key, especially when it has to do with bond yields, right? Because we're looking at a global market. If you get a global reflation that is truly global in nature, then could we start to see bond yields increase meaningfully in the United States? Today at 8:30 a.m., we are going to have on this program Bill Dudley, former New York Fed president, talking about bank regulation, actually coming out in favor of less of it. Kind of interesting after the Archegos situation. But this has to do with some of the Treasury purchases and the lending power kind of bleeding into those bank earnings that we start getting starting on Wednesday this week. Then at 1 p.m., this is what you were talking about, John. The supply starts coming, $38 billion of 10-year notes. Really key to see what the metrics underpinning this auction are. How many foreign buyers are coming in? Because in the past couple of auctions, you've started to see them get more interested as the risk reward starts to look a bit better. The high yielding area being the United States. And then at 1:45 p.m., I'm curious to see what happens here. A bipartisan group of Congress members are going to meet with President Biden and Vice President Kamala Harris to talk about the $2.3 trillion stimulus plan. How much agreement will there be on taxes? That will be the key issue, John, as we're looking ahead to how to pay for this.
Lisa, very much so. Can we just look ahead to retail sales on Thursday?
Please.
Just quickly, Tom, we'll talk a lot about CPI through this program. We should talk about CPI a lot through this program. Retail sales this coming Thursday. Bank of America looking for 11.5% for the month of March. That's a boom, Tom.
Well, 12 months trailing, it's a boom. You're going to get a lot of these numbers 12 months trailing. I'm much more interested, John, in the quarter to quarter, almost week to week, month to month nuance that
Tom, that's the month on month.
Yeah, and
that's the month on month.
Yeah, and well, okay, that's month on month. Excuse me, I stand corrected. But John, I look at where we are, and the fact is, it's a boom economy, and it's an original.
Good morning, traders.
This is not
Back. Hope your weekend was okay, and straight right to the business. We're looking to sell short Bitcoin, so I'm planning to open new order to sell short. So if you're up to Bitcoin, the price I'm looking to sell 60,382.9. Okay, 60,382.9. Somewhere here I will adjust. So if you're looking to sell short or trade Bitcoin, stay with me, place an order, and I'll let you know later on what I'm planning to do with when it will get filled. Okay, so at this moment you still have time, and please climb on board, and let's see what's going to happen next. Don't forget, we still hold one position on Bitcoin at 58,000. Okay? Stay safe. I'll speak to you later, guys.
Really doesn't see any more inflation now than it did back then. It's been a wild ride, but along that way, the market's stayed pretty consistent in thinking that there are impediments to structural inflation.
How do you know?
Go ahead.
How do you know if the market's wrong? I mean, especially as we get supply chain disruptions, especially as we get the idea of labor shortages that people are saying are temporary as you try to restart an entire travel economy. How do you determine temporary versus more permanent?
That's what I was wondering about. I was looking back at where we used to be, and I think what's interesting is the market isn't saying that well, it could be wrong, right? But what the market's saying is the next 3-4 years of inflation are going to be higher. And by the way, that's priced with the Fed buying a tremendous amount, about half of the supply of tips. So certainly the Fed has done its job in trying to get expectations higher. But if the market's wrong, I think where it has to be wrong is that global output gaps have to close more quickly, right? Back then, the participation rate in the U.S. labor market was 67%. Now it's 61.5%. So what you would need to do is really get the U.S. and other parts of the world, Europe, emerging markets, to have enough growth to close output gaps globally, to really push up the expectation that prices will go up structurally. Right now, it just feels like, as you guys were saying, boom time economies that at some point will weaken and level back out, so reflation, but not runaway inflation.
Brian, that's exactly the question that we asked Vice Chair Clarida on Friday. How will they know they are wrong? How and when will they know they're wrong? And he did give us an answer. He was looking at year-end going into 2022. Now, economists might be able to wait that long, Brian. I don't think market participants can they?
No, market will get antsy. But again, I was thinking about 04, 05, 06, right before the great financial crisis, when the markets got antsy again, right? The Fed was moving too slowly. They were going 25 basis points very, very slowly. And expectations went up. But that was market pricing expectations. You really never saw the consumer behavior, right? You never saw people say, oh my goodness, if I don't spend this money now, the cost of goods will be higher later. So it's really hard to measure, right? We have the UMich survey. There's a couple places we can see inflation expectations. But what we really want to see is the savings rate fall, right? Or what the Fed would be afraid of is that people start to behave as if the money is burning a hole, right? If you don't buy that next thing now, your money might be worth less later. The problem is we spent the last 30 years with the opposite, right? With globalization, with this disinflation, with demographics that suggest otherwise. So I'm not sure the Fed's as worried as the market wants them to be. The market may push them, but I think the Fed could be very patient.
Well, markets have to price in a balance of risks. And right now, what is more expensive? Betting on inflation to overshoot or undershoot? Basically, buying treasuries or selling them short on the long end?
No, it's a great question. Listen, it's gotten harder with steeper yield curves and higher forward rates and break-even inflation rates back to normal. I think it's a bit more balanced, but we would suggest the risk is still that we overshoot, right? The market could get excited if you see better growth numbers throughout. If you see more stimulus, right? The stimulus being temporary gives the people who betting against inflation an edge. But if the government gets more aggressive, if the Fed impresses the market and continues to toe the line about the long-term structural underpricing of inflation, we could move higher. I don't think we can move a lot higher. I think it would be an overshoot, but certainly I think the market still believes you could get higher rates before you got sharply lower ones.
Hey, Brian, always good to catch up, sir. Good to see you. Head of a key week for this market, for this global economy. Brian Weinstein there, Morgan Stanley Investment Management Head of Global Fixed Income. CPI inflation in America coming out tomorrow morning. Resale sales coming out on Thursday. Wednesday, big bang. Kicking off earnings season with JP Morgan top of the pile. Got to bring you some breaking news just quickly. Crossing the Bloomberg in the last couple of minutes. Tom, from the PBOC, the People's Bank of China, the Chinese central bank, Ant Group to become a financial holding company in an overhaul. Interesting, it's the central bank announcing this, not the company. Ant Group to become a financial holding company in the overhaul, Tom.
Yeah, I agree. It's about the central bank, the PBOC involved. And what is extraordinary here, John, is that their basic money market fund will be in some way significantly reduced. I mean, you see Alibaba popping here on the news, but again, it just shows how things are changing in China. It's good to have Jing Ulrich on with us.
Hey, Tom, looking forward to that conversation later. Did you see the response from Alibaba to the record fine that they received? Just compare and contrast how a US tech company might respond to a record fine from the United States or from Europe, Lisa. Let me just read this quote from Alibaba after receiving a record antitrust fine from China. They said the following: Alibaba would not have achieved our growth without sound government regulation and service, and the critical oversight, tolerance and support from all of our constituencies have been crucial to our development. For this, we are full of gratitude and respect. That's how you deal with regulatory issues in China, Lisa. And Tom, I have to say, here in the United States, Tom, you'd anticipate a very different response, wouldn't you?
I think it's a new world. And, you know, it's the same thing with the changes in Hong Kong that we've seen and the change in all the politics involved. Over the weekend, all of the discussion, the tensions between Taiwan and China.
Yeah.
And, you know, I'm sorry, I'm going to fold the financial debate into the political debate.
Can you imagine that, Lisa? Mark Zuckerberg running that quote. For this, we're full of gratitude.
Thank you.
And
Thank
respect.
you.
Thank
Can we
you
have
for the
another? Please, can we have another, and maybe we can do something else for you? I love that. That's what I was laughing about. I was thinking about that quote and thinking about how much the PBOC has their hand on all of big tech in China.
Two very different systems. Coming up in the 8 o'clock hour, in a couple of hours from now, looking forward to catching up with Bill Dudley, former New York Fed president. From New York City this morning, good morning to you all. Counting it down to a really interesting week ahead, stateside and worldwide. S&P 500 futures pulling back from all-time highs. This is Bloomberg.
First News, I'm Rishika Gupta. Federal Reserve Chair Jerome Powell says the U.S. economy is at an inflection point. Powell told the CBS program 60 Minutes there is strong growth and hiring ahead thanks to rising vaccinations and powerful policy support. But he warns that the coronavirus is still a threat. Powell says it's going to be smart if people continue to socially distance and wear masks. The Biden administration is stepping up scrutiny of China's plans for a digital yuan. Some officials are concerned the move could kick off a long-term bid to topple the dollar as the world's dominant reserve currency. Right now, the yuan makes up just a fraction of foreign exchange compared to the dollar. And after China imposed a record $2.8 billion antitrust fine on Alibaba, the e-commerce giant did an unusual thing. It thanked regulators for helping it grow. For Alibaba, the fine was less severe than many feared, and it helps lift a cloud of uncertainty over Jack Ma's internet empire. Shares rose today in Hong Kong. And Microsoft is making a massive bet on healthcare artificial intelligence. Bloomberg's learned the software giant is set to buy Nuance Communications in a deal with an equity value of about $16 billion. Microsoft's been working with Nuance on AI software that helps doctors capture patient discussions and integrate them into electronic health records. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
Model minority myth wasn't something that was fabricated by the Asian Americans. It was created as a tool to alienate the Black and the Asian American communities, and it was incredibly successful.
We know the racism didn't begin yesterday. We know it's probably not going to end tomorrow, but it is our job to make sure that there's progress and we keep people safe, give people dignity.
I spent a lot of time last year to just listen, to understand, to reflect, and understand what I could do as a leader of this organization.
For many years, we've been very shareholder focused, and now there really is much more of a community requirement.
The economic downturn in the US, we're seeing unemployment and income losses affecting women more than men.
2/3 of the jobs lost in South Africa were women's jobs. So I think we're in a moment of crisis.
Clearly, our societies are reproducing, not reducing inequality.
We need better public policy and we need companies to step up.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
The president should have come back with a counteroffer, and if he will do that with the Republicans that are meeting with him in the White House tomorrow, I think we can get somewhere and have a much bigger infrastructure package than we were able to do under the last administration.
Senator Roger Wicker there, the Republican from Mississippi, speaking to ABC over the weekend. From New York City this morning, good morning. Alongside Tom Keene, Lisa Bravitz, I'm Jonathan Ferro. This Monday morning, here's your price action. The S&P 500, 3 big weeks of gains on the S&P, all-time highs and through 4,100 at the close on Friday. Equities pulled back just a little bit, softer by about 7 or 8 points on the S&P. We're down 0.2%. Into the bond market, Lisa ran you through the supply a little bit later today and through the week. Big supply on a 10-year side of things. A little bit later this afternoon. Ahead of that, yields in about a half a basis point to 165.33. Euro dollar 119, a 119 handle as vaccinations in Europe improve. But let's just spend about 30 seconds, if we can, Tom, talking about vaccinations in America. Andy Slavitt, the senior advisor to the White House, tweeting over the weekend on Saturday, vaccination record, a new record, 4.6 million shots recorded today. Saturday, 500,000 above the prior record. Just tremendous numbers continuing in this country, Tom.
And rapidly getting, John, to where you wonder with vaccinations and the people that have decided not to be vaccinated when we run up against the limit.
We've widened out the eligibility pool in a big, big way in this country in the last couple of weeks. I agree with you, Tom.
Very good. Let us continue here and on Washington, maybe taking a victory lap in the vaccination or other challenges. Martin Schenker joins us, our editor-at-large, this morning. Marty, Roger Wicker there, and he's from the land of Van Morrison's Tupelo honey and down with the Mississippi that is all Republican. Is there any sense on the bipartisan meter of any bipartisan? I don't see many bipartisan people being bipartisan.
They're not. And, you know, it's interesting that some of the mainstream Republicans who actually do wield power in Congress, people like Susan Collins,
Murkowski
are not attending.
Why?
And these are not the mainstream Republicans.
Silent?
Because they are not, they're going to not criticize their colleagues and allow them to have their moment in the sun. But they are not going anywhere near this infrastructure plan.
Marty, we thought China might be the issue to tie the two sides together. Secretary Blinken over the weekend with some pretty strong words for the Chinese Communist Party. Why is that not being as effective as some people thought it might be?
Because I think that it's a tug and push on the whole issue of whether or not Republicans can afford to show bipartisanship, even in the context of China, to support a close to $3 trillion unprecedented jobs recovery plan from Biden. And they just don't want to go there.
That's the optics. What about the substance, Marty, of this particular plan?
Well, the substance is, and, you know, it's been a very interesting debate because Republicans have criticized this plan because it isn't roads and bridges exclusively, but it is an investment in human capital. So there's this real intellectual argument going on just what is infrastructure and what's the role of government in in promoting societal change.
What kind of pressure is there from the C-suite, given the fact that CEOs are looking to affiliate themselves with whichever party gives them the money and helps support the infrastructure that they're looking for?
You know, it's very interesting because you had Jeff Bezos at Amazon supporting a rise in the corporate tax rate to 28% and the infrastructure plan. Of course, he stands to benefit from infrastructure such as roads and airports. But there hasn't been a groundswell of corporate support. In fact, there is a PR campaign being produced for television in opposition of any increase in the corporate tax rate.
Okay, so let's put aside infrastructure and look at other areas where there could be bipartisan support. I'm thinking, for example, at noon today, there's going to be a meeting at the White House on infrastructure when it comes to the supply chain, when it comes to trying to help particularly the chip sector. And I'm thinking about Apple having product delayed as a result to a chip shortage. Is there bipartisan support for something to shore up supply chains?
Sure there is. But the question is, how do you accomplish it? Look, it takes about 2 years to build a semiconductor plant, and that's if you get all the agreements. And the Republicans are definitely supportive of strengthening the supply chain and moving away from dependence on outside suppliers. But this is going to take time, and there is no solution. And as our reporting says, there's none expected out of this semiconductor summit today.
Who are you watching in Washington? Who, you know?
Well, I mean,
the moderates, both sides, the liberals, the conservatives. Who are you watching?
Well, it's it's no surprise. It's Joe Manchin of West Virginia. I mean, he has laid down the law. He will not accept any change in the filibuster. He wants bipartisanship on any infrastructure plan, and we'll see if he holds out. Without Joe Manchin, there is no deal.
Marty, before we let you go, I think we need to talk about what is happening with corporations getting more and more involved in politics in the United States of America. There was a call over the weekend. What are we learning about the latest push from corporations to include themselves in the discussion about voting rights beyond just Georgia around this country, Marty?
I mean, it's relatively unheard of for companies to actually band together to take a position on a controversial social subject such as voting rights. But there were more than 100 CEOs on that call, on that Zoom call this weekend, and apparently they've reached some sort of consensus about moving towards ensuring voting rights as a matter of societal importance. And so companies are being forced to confront not just the views of their customers, but of their employees, and they have to move beyond just a simple search for profits.
We'll catch up with Emily Wilkins a little bit later this hour down in D.C. on this subject. Marty, always great to catch up, even this early in the morning, sir. Thanks for being with us. Marty Schenker there, Bloomberg editor at large. Tom, that big push from corporations to involve themselves in a big issue. And as Marty alluded to, the consumer base, a big part of that.
Well, the consumer base is a big part of that, but it's fascinating how alone the pro-Georgia executive and legislative branch crew is. I mean, it just continues to mount each and every day.
More and more companies, Lisa, are under pressure to have a view on something that maybe in many ways some corporations, at least, are reluctant to have one.
Well, after the George Floyd incident, there was a greater political push by a lot of companies with their employees and a lot of consumers saying, you guys cannot stand on the sidelines. And there was a lot more money put toward these efforts. And yet there were a lot of people saying, that's just lip service. What are you actually going to do? Are you going to take a stand when it matters? I wonder if it's not just consumers, but also shareholders, the whole ESG movement, how much that actually, from an investment side, is also shifting some of the political environment among corporations.
Does this begin and end in the United States of America? And that's a Republican talking point right now, Tom. They're willing to include themselves on big political issues here in America at home. Are they willing to do the same in places like China?
Well, we'll see. I mean, I think it's unique to America right now, and the China thing is complex. John, we're publishing more on Ant right now, and you really wonder, are they trying to make Ant off of Alibaba a state-owned enterprise?
I think there's a strong message
too long a language
for Jack Ma here, Tom, in the last 12 months.
We're way past that.
Well,
big time.
It's a huge deal. I mean, they're talking about, stopping the information monopoly.
The data. It's all about the data. That's it, John.
From New York City this morning, good morning. Alongside Lisa Bramett and Tom Keane, I'm Jonathan Ferro. Your market shaping up as follows on the S&P 500. Record highs on the S&P at the close on Friday, pulling back 8 points and down 0.2%. Big week ahead. Earnings in America starting on Wednesday with JP Morgan. From New York City this morning, good morning. This is Bloomberg Surveillance.
Madame Lagarde, has the balance of risk actually shifted since the last policy meeting?
Well, our balance of risk is still tilted to the downside in the short term, but it is much more balanced in the medium term.
What are markets exactly playing out at the moment? They seem to be continuing testing central banks.
They can test us as much as they want. We have a mandate, we have an aim. We're going to be riveted to that, and we're going to do what is required.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
From New York City, for our audience worldwide, this is Bloomberg Surveillance. Let's get a check on a price action this Monday morning. Good morning to you all. Your S&P 500 futures down a little bit, off by 0.2% on the NASDAQ, off by 1/3%. The NASDAQ 100 last week, big week, up by around about 3.9%. The Russell down on the week, off by almost 0.5%. And Morgan Stanley out with a really interesting note over the weekend. Mr. Michael Wilson talking about the underperformance of the Russell compared to the S&P 500. Since the small caps peak back on March 12th, 8 percentage points of underperformance relative to the S&P. Is it now about execution risk? That's the big question from Morgan Stanley. Switch up the board and get to the bond market. 2s, 10s, 30s. It is not just about CPI tomorrow. It's about retail sales on Thursday. Bank of America looking for 11.5%, not year on year, month on month for the month of March for retail sales. Big boom. Right now, yields in just a little bit, 165.51 on 10s, on 30s, 232.16. Yields basically unchanged on a session. So let's finish on this in FX. Switch up the board. Euro sterling. Just want to have a little chat about euro sterling for you briefly. Here's the chart, year to date. That is right there, that trend lower, the vaccine trade. The UK, stellar effort. Europe, not so much. Now things are starting to change. Better numbers out of Europe, the continent. Really good numbers out of Germany over the last couple of weeks too. We improve. Is this an inflection point? And is that what you see at the very end of the chart there? Euro sterling starting to inflect just a little bit higher. That bounce, Tom, is that the trade? Does this start to turn around as Europe starts to improve?
Second and third chart I looked at this morning, and I triangulated it to U.S. dollar, and clearly euro sterling has a greater 2 standard deviation dynamic than what we see off euro dollar. Let us continue now, and this is an exceptionally important interview. In the last 48 hours of surveillance, we've had terrific interviews on economics, and now a must-listen, must-watch on China. Jing Ulrich is with J.P. Morgan. She is vice chairman of Asia Pacific Banking for the firm, and that barely describes her commitment to a dialogue between the Western world and China. We're thrilled that Jing Ulrich could join us this morning. Jing, I want to talk about Hong Kong. I want to talk about a forever changed Hong Kong. How much has Hong Kong changed, and what does it look like for the J.P. Morgan company in the coming years?
Well, Hong Kong, I've been here for many years, and the Hong Kong financial markets are extremely buoyant, as you could see from many activity in the IPO market. Many of the innovative companies from China are coming to the Hong Kong market to list. In terms of the recovery from the pandemic, Hong Kong actually has done pretty well. If you think about it, right, Hong Kong is a city of 7 million people. Altogether, I think there have been about 11,000 cases of COVID since the pandemic began. And these days, I think the pandemic is definitely coming under control. Economic activity is actually returning to normal slowly but steadily.
Jing, with your influence, your experience, the breadth of your knowledge of the Pacific Rim, do you look at Hong Kong that it will be changed for Western banking, or will it be business as usual?
Well, so far, it's been business as usual. We're as busy as ever, helping our clients among the corporates and also investors. And remember, China has a huge amount of liquidity as well. Through the Connect program between Shanghai and Hong Kong, Shenzhen and Hong Kong, there's a lot of mainland money actually coming to Hong Kong to invest in world-class companies.
Jing, can we talk about what's happening on the mainland right now? That equity market has really struggled over the last month or so. What's going on?
Well, the equity markets in China have performed differently from the U.S. The U.S. indices are near all-time highs. The China market had done very well up until February of this year. I think this has to do with the liquidity situation in China. As you know, normally, the Chinese equity market performance is very much in sync with the credit cycle. Now that the mainland authorities are actually tightening liquidity because economic recovery is firmly on track, they want to control the leverage ratio, they want to control the risk of overheating. So therefore, as they really reining in the credit growth, you're seeing some softening of the mainland markets. They had done very, very well throughout 2020 and also into January and February this year. I think this is taking a breather.
Not just reining in credit, they're reining in some of the big tech players. And I understand you can't do single names, so I'll do it for you. Alibaba and Financial very much in the news at the moment, Jing. And I think for people outside of the mainland, outside of Hong Kong even, I think they're struggling with what's happening with regulation on the ground around some big tech players. These were big themes that investors worldwide wanted to get some traction, some exposure to. What are you telling them now?
Well, despite the recent market volatility, we think the digital economy in China is still alive and well, especially since the pandemic. The digital way of life is definitely not turning back. If you look at e-commerce, you look at the sharing economy, you look at payments, everything is growing in a very robust fashion. So we believe the medium to long-term outlook for the large tech companies remains very robust.
Although you've got to wonder which area people are going to invest in big tech. Do you find that some of your international investors are more hesitant to invest in Chinese big tech because of the regulatory oversight that does seem to be tightening?
Actually, many international investors are looking at China as an asset class. They find themselves actually underexposed to China. If you think about the next 10 years, the Chinese economy is going to surpass the US economy to become the largest in the world. However, if you look at the weighting of global funds in China, it remains very low. So we're actually looking at international institutions finding different ways to gain more exposure to China, both equities and fixed income securities. And on the fixed income side, I know you guys talk about the 10-year treasury yield all the time, every day on your show. China is 3.2% on the 10-year right now. So that's relatively attractive for international funds really seeking to get some additional yields.
Can you dovetail the advent of a digital yuan into this conversation, the idea that that could potentially lure more money into the nation due to it being on the cusp of more modern technology? Do you view a digital yuan as bringing more capital into the nation?
Well, I think China has been very judicious in terms of bringing capital onshore because they don't want too much capital flooding into the country, causing, bubble concerns. And there's ample liquidity already in China. So I think when it comes to capital inflows and outflows, the authorities are very careful in terms of controlling what types of money comes into the country and what types of money can flow outside of the country. So we're seeing, obviously, in the recent couple of years, the gradual internationalization of the Chinese currency. We're seeing the Chinese currency being used a lot more in international trade, but there's a long way to go. In the next 10 years, as I said, China will become the largest economy in the world, but the Chinese yuan is still not fully convertible on the capital account. So it's going to be a steady journey of gradual opening up. And I do believe in the coming several years, capital inflows and outflows will gradually become loosened.
Jing, I want to speak about not so much the politics of the moment or, frankly, the politics of the future, but the reality that business can often lead politics. J.P. Morgan has been in Hong Kong for 90 years or so. J.P. Morgan provided leadership in being in Taipei in 1970. Explain how business and financials will interlink with our politics in this delicate debate between the mainland and Taiwan.
Well, I will leave the politics to politicians. So we, as a firm, are very committed to the Asia-Pacific region, of course, including China and the rest of the economies. And as you said, we've been in the region in some countries for over 100 years. And this year, we're actually celebrating our 100th anniversary in China. So we're here to serve our clients, both international clients who want to do more business in the region, and also local clients who actually want to go global. So we are here really acting as a bridge between East and West, and we're here to facilitate capital transactions both in and out of the region.
Jing, some really, really sensitive topics.
Yeah.
We appreciate your time this morning to comment on some of them. Jing Ulrich there, JP Morgan Chase, Managing Director and Asia Pacific Vice Chairman. I say this with a tremendous amount of respect for Jing, Tom. I think that's an example of how delicate things still are in the region. We will leave the politics to the politicians. That is not something you hear in the United States or in Europe for that matter either.
She is so esteemed in being where she is and being as consistent as she's been with Deutsche Bank and then with JP Morgan, John, over the years. And that was a real clinic and like you question after question. of delicacy there, and that's a representation of Mr. Diamond's interest on the Pacific Rim.
As we talk about Alibaba this morning, hopefully for the company, wrapping up an antitrust probe, that stock up in the pre-market, Tom, by 5.7% here stateside.
Well, let me get out front of it. Are we governmentizing Alibaba? Is that what's really going on
I
here?
think some people might say that is exactly what is happening, Tom. I think that's the view of some people, Lisa. The regulators come down on this company hard, and I think it's an example of how different it is in China compared to the United States. They're not exactly pushing back, are they?
No. Basically, you've got a Chinese government that does not want all financial data held by a company that could potentially use it in a multitude of ways. But in all honesty, John, we don't have a company like Alibaba in the United States that's dealing with the financial side so heavily, in addition to shopping, in addition to all these other wings. I mean, this is not analogous completely to some of the big tech in the United States.
This is a big story this morning, but it's on the periphery of what is about to happen this week. CPI in America tomorrow morning. We have jobless claims Thursday morning, but retail sales could be the big headline number there for you. Then in between, earnings in America. Looking forward to earnings season stateside, kicking off Wednesday with JP Morgan. From New York City this morning, good morning to you all. Alongside Tom Keene, Elisa Abramowitz, I'm Jonathan Ferro. Here's a taste of the price action for you. Going into the opening bell a little bit later this morning, in a couple of hours' time. Equities down 8 points on the S&P 500, up by 0.2%. Hey, Tom, look at where we started the year and what the year-end forecasts were. JP Morgan, 4,400. Goldman, 4,300. UBS, 4,100 with there. It's April 12th.
Look at the last hour of trading on Friday. That was a moonshot.
Yep. Coming up a whole lot more. We'll catch up with Joshua Sharfstein, Johns Hopkins Bloomberg School of Public Health Vice Dean. With the vaccination numbers in America continuing to rocket, how high can they go? 4.6 million on Saturday. Unreal. This is Bloomberg.
With the First Word News, I'm Rishika Gupta. Regulators in China have told Ant Group to become a financial holding company that could be regulated more like a bank. That's their first significant guidance for the financial technology company since they halted Ant's record IPO. The People's Bank of China also told Ant to rectify unfair competition in its payments business and to end information monopoly. Fed Chair Jerome Powell sees stronger growth and an improving labor market ahead for the U.S., but he tells the CBS program 60 Minutes the principal risk is that the coronavirus would spread again. Powell also said the Fed would do everything it can to support the economy for as long as it takes to complete the recovery. Iran blames what it calls nuclear terrorism for an incident at the country's top uranium enrichment facility. Their head Iranian atomic official said the disruption shows there was an attempt to thwart both Iran's nuclear progress and the ongoing talks to revive a 2015 agreement. Iran began injecting uranium gas into new centrifuges at the facility on Saturday. And Apple is facing a supply shortage that's affecting the upcoming iPad Pro. There are production issues with the next generation display that's supposed to be a highlight of the new device. The new iPads are planned for introduction this month. Bloomberg's learned that the production hiccup could mean that the larger version of the iPad Pro will ship later. Bitcoin approached an all-time high today. The world's largest cryptocurrency crossed that $61,000 level at one point, just shy of a record set a month ago. The biggest U.S. cryptocurrency exchange is set to go public on Wednesday. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
is absolutely core to our business. It's almost 20% of our franchise revenues globally, which is significantly more than most of our global peers who are more in the mid-teens.
We want to invest, grow in China, but also we are also investing in the rest of Asia as well. Our top line growth for the region has been close to 24% last year, almost 20% of the group's revenue as a percentage of the revenue of the group. So, and this is where the group is counting on the growth.
We see company after company, these are corporates committing to net zero. So pretty much across the board, there is an enthusiasm for putting capital to work to try to get us to a better carbon future.
Credit Suisse has a fantastic brand name in Asia. We have obviously strong positions in Singapore and Hong Kong as our two main hubs, but across the region.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
That over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Or maybe even 2 months at most, where we need to keep our public health interventions in place while we're vaccinating the general population. We're doing such a fantastic job of vaccinating people in this country, but we need the other tools to keep the case numbers down. Otherwise, we're going to find ourselves in a situation where we have variants springing up everywhere, and we're going to lose the advantage that we have with the vaccine.
We're doing a fantastic job in this country. Andrew Pekos there, Johns Hopkins Bloomberg School professor from New York City this morning. Good morning. Alongside Tom Keene, Lisa Bravitz, I'm Jonathan Ferro. Here's the Monday morning price action. Equities coming in 8 points on the S&P through all-time highs, through 4,100 on Friday, and a little bit lower, down 0.2% right now. Yields unchanged on a 10-year, 165.86. Not much to talk of right now. Euro dollar 119.16, up 0.1%. We talked about the improvement in the rollout in Europe. Let's just talk about America just a little bit, Tom. We had a 4.6 million day on Saturday, according to the administration, according to a senior advisor to the president. It broke the daily record by 500,000. 7-day rolling average, daily average is still just north of 3 million, though. We had some quiet days around the Easter holiday. They'll drop out in the next couple of days, Tom, so expect that to climb even higher.
It's all good news, and everybody's doing what they're doing. We're all seeing it, each of our families, anecdotally as well, grinding it out day by day. And then there's a blunt math of experience. Joshua Sharfstein joins us at Johns Hopkins with Andrew Pekos. Dr. Sharfstein, thank you so much for joining today. And I want to go to the simple thing we have learned, which if cases are flat or even increase, at some point increased deaths follow on. If we have cases now where they are, and deaths actually doing pretty well now where they are, what does it mean for late summer within the dynamic between those two events?
Well, we know that in some parts of the country, we're not just seeing cases go up, but we're also seeing hospitalizations. And I think that is very likely going to be correlated with deaths. So I think hospitalizations is in between those two things. It's possible that because the more seriously at risk people are getting vaccinated, that there won't be quite the association between cases and deaths that we saw earlier in the pandemic. But if hospitalizations are rising, I think it's a pretty fair bet that we'll see deaths rising too.
Are we prolonging our pandemic agony because we're not doing strict lockdowns like we observe in Europe?
Well, I don't even think we need strict lockdowns. I think if there were a little bit more attention to some of the critical aspects of disease control here in the United States, we would have fewer cases, fewer hospitalizations, and fewer deaths. So I'm talking about continued, reliable mask wearing and distancing. I think in areas where we're seeing a big resurgence, there should be some reasonable restrictions on venues where we know there's going to be a very high risk of transmission. The thing to keep in mind is that community transmission drives infections. The more cases you have, the more cases you have. And that is true even if people are vaccinated, because the vaccines aren't perfect. So the more people out there with coronavirus, the more people who've been vaccinated will get sick too.
Can we talk about children as vectors of the disease, children suffering from the disease because they are not able to be vaccinated? In other words, how much are we at risk of this pandemic continuing and even having mutations, et cetera, with kids unvaccinated throughout the summer and possibly beyond?
Well, I think we're seeing, most of the cases still among older people. Older than kids at least. And kids, are less likely to pass it on as well. I think if kids take precautions, wearing masks in class, then the risk is generally pretty low. So I'm less worried about the kids being, a source of a huge outbreak, although certainly we know that the infection won't go away because kids will still be able to have it. And it will take really an entire society vaccination if we get to that point to really drive the cases low.
Given the record pace of vaccination in the United States, a lot of people are thinking about the post-pandemic reality. And I wonder about the sharing economy that was gaining so much esteem ahead of the pandemic, the idea of public transportation being recommended, ride sharing being very much the rage. Can that ever come back, given COVID-19 never going away and possibly new iterations coming out?
Oh, I think it can come back. It depends a lot on what happens with the pandemic. I think as the community transmission goes down and our total cases go down, people will feel a lot more confident, particularly if they're vaccinated. I think, the variants are certainly a big question mark. And as you may know, there's a little bit of evidence that the variants are more likely to cause an infection among people who are vaccinated now. But I think that, if we continue to do what we need to do, we vaccinate a lot of people, we, are able to be vigilant against the disease, I think there's a lot of things we'll be able to do. The sharing economy is just one of them.
Joshua, help me through a delicate issue. Various polls in the last 12 months suggesting an increasing mistrust of institutions, including the CDC, in this country, in the United States. There's a feeling that somehow things are being kept from people, including the data around how effective these vaccines actually are. For instance, there's a feeling we're not being told how safe we are once we have been vaccinated, because there is a feeling that certain officials and institutions believe that we will then go out and do crazy things like go back to how we were before. So, Joshua, I'm trying to understand from your perspective how you navigate that particular issue and where you stand on that debate.
Well, I think that, the CDC is releasing a lot of data that, the vaccines are actually quite protective, but they're not perfectly protective. So, sometimes people want to hear it's all safe or it's all unsafe, or it works completely well or it doesn't work at all. But we have to be able to live in a little bit of the gray area and realize that, these are highly effective vaccines. But if there's a lot of coronavirus out there, some people who've been vaccinated are going to get sick. And, hopefully not too sick, and hopefully they won't pass the virus on to other people, but they will be able to pass the virus on to other people. And so what we need to do is keep an eye not just on ourselves, but on what's happening in our communities and try together to get the rate of transmission down, because that will be the thing that really gives the green light to a whole bunch of activities.
Joshua, thanks for being with us this morning, sir. As always, it's good to catch up. Joshua Sharfstein there, Johns Hopkins Bloomberg School of Public Health Vice Dean. We've gone through the numbers, Tom. The numbers are tremendous. 4.6 million, according to one senior advisor. That's the amount of vaccinations that took place in this country over the weekend in a single day. But, Tom, as you've indicated, we've really aggressively widened the pool of eligibility in this country over the last several weeks. And I think those improving numbers are a reflection of how prepared we are to vaccinate more people in this country, but also a reflection of how much longer the line is now, because people can actually line up to get it. As you indicate, in the next several months, Tom, maybe even several weeks, when do we start to raise the question about acceptance issues weighing on that number?
Well, there's some good analysis of this. I think there'll be much more in the next 10 days, John. And the bottom line is sometime the end of April in selected geographies around the nation, we run out of people that really want to get the vaccination. That's a new thing. It's not here yet, but some are suggesting, experts are suggesting end of April, early May.
Yeah, many people anticipating that maybe in the next several weeks. Alongside Tom Keane, Lisa Brabitz, I'm Jonathan Ferro. On its equity market, all-time highs on the S&P 500, the Nasdaq back in a big way in the last several weeks. The small caps underperforming. That's been the story of the last month going into earnings season. Your equity market right now down 8 on the S&P, down 0.2%. Coming up, David Kotok, Cumberland Advisors CIO from New York City this morning. Good morning to you all as we kick off a brand new trading week from New York. This is Bloomberg.
That Norway sells way more electric cars per capita than the U.S.? Norway. Well, I won't stand for it.
In this neighborhood just outside Oslo, the majority of cars are electric. Last year, Norway became the first country in the world to sell more electric cars than any other. In December, EV market share was at 67%. In 2025, the country wants all cars sold to be zero emission.
Hey, Norway, listen up, you fish-loving... Oh, this place is adorable. Damn it.
But why is Norway leading this development? The country is rocky, it's ice cold, and with huge distances. The easy answer is politics. By giving the consumers benefits that pay off, more people will go electric when they're getting a new car. These perks could be no VAT when buying the car, reduced tolls, the possibility to drive in the bus lane, and quite a bit of free parking as well. 2021 is an election year in Norway, and the Climate and Environment Minister Sveinung Rotevatn believe the EV perks will be a hot topic in the campaigns, where removal of the perks is set to be a central issue.
I have asked the Securities and Futures Commission and the Hong Kong EX to work together to explore the viability of our own Hong Kong version of specs. We remain very confident on the competitiveness of the Hong Kong stock market.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
We want our our policy to be robust if our models break down.
In the second half of the year, I think you're going to see things really start to ramp up. So, they're going to find themselves sort of behind the curve.
There'll be numerous tests of the Fed that the Fed will have to reply to over time.
There's kind of still this catch-up that's happening in correcting for the COVID shock.
We are to some extent flying blind here. This pandemic is quite different than the financial crisis.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
The boom is here from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance live on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow, and Tom Keene later this week will see the data behind that boom.
And an incredibly important conversation coming up in moments with a guy who's usually very cautious, very reticent, encyclopedic on American financial history. And John, if we're like David Kotak, it's load the boat Monday.
We have had an 85% move of the March 2020
I thought
low.
you meant
Tom,
Friday
85.
afternoon.
85. It's felt that way over the last 6 months too, hasn't it? A huge rip off the gains off behind the vaccination news and the headlines we've seen over the last 6 months. Tom, it gets better and better. And this is the week that we start to see the data. Real sales in America on Thursday. I mentioned Bank of America a little bit earlier this morning, looking for 11.5%. Then the inflation debate kicks off into higher gear when we actually start to see the numbers, Tom. 2.5%. Many people expect year on year in a CPI figure tomorrow morning.
Well, the CPI figure, and of course you go to core there, and there's been a real reaffirmation of study of core within the academics. But John, one data point, I know you're going to do a data check here. I'll try to help. 41.12 on SPX futures. We are not adjusted yet to this level.
Record highs, Lisa. 4,100 was the year-end forecast for the likes of UBS coming into 2021, and here we are. Just through the first quarter.
John,
it feels like year-end. Is it year-end already, Tom?
Yeah, it'll be year-end again.
The Red Sox are in first place, playing 600-plus ball.
Yeah,
that's going to end at some point.
I understand you've won 6 in a row. Unfortunately for you, you can't end the season right now.
Year-end.
Exactly.
The wishes of the likes of UBS. The year starts for me this week, right here, right now, tomorrow morning, Lisa, 8:30 a.m., when we get that inflation print. This is the data we've been looking to kick off 2021 with. This is where the year begins.
Well, and just to talk about sort of the two-pronged tension here, you've got the low rates fueling this gain in equities, and then you have earnings coming on strong that are not necessarily being accompanied by inflation. I was looking, though, at a metric, and this I thought was fascinating, that in order to bring S&P's multiple to a decade-long average, you have to have a 15% increase in earnings in 2023 above what equity analysts are pricing in, just to give you a sense of how much people are relying on the benchmark rates remaining low into 2023, John.
A really good write-up on a Bloomberg terminal about this story, which I'm sure you've read as well, Lisa. Look out for that on the Bloomberg and on Bloomberg.com. Let's get to the price action this Monday morning. This is how things shape up. Tom talking about a 4,100 handle on the S&P 500. There it is, 41.12. We're down 7 points on a day off by around about 0.2% of 1% in the bond market. Tom, can you imagine if you were in cash? 165.86.
Yes,
let me imagine.
166 on 10.
I'm imagining.
Just consider
I'm
that.
Cash.
How's it feel? How's it feel?
I'm imagining.
How does it feel, Tom? How does it feel? Euro dollar 119.10, up about 0.1%. Tom, things improving in Europe. Maria Tadeo of Brussels walking us through that over the last week. Matt Miller doing the same.
Yes.
Vaccination starting to ramp up.
Yeah, it is in Germany. It's a huge deal. I'm sorry, John. It's a huge, huge deal. This turnaround. And what do you say, John? I mean, to me, it's been like a 4 or 5 day turnaround.
For what? The NASDAQ over the last several weeks
Germany.
it has been. For Germany. Oh, yeah, sure.
Yeah.
Totally agree. Inflection point. Inflection point for Europe. Really important moment
like
for the
Tottenham.
continent. Just like your Tots, your Spurs over the weekend against Manchester United. Do you want to do that right now? Or should we move on?
That was so sad.
Should we move on?
Gunners won.
Lisa, let's move on. Did Arsenal win?
Let's move on.
Yep, Arsenal won, Tots lost. Just want to throw that out
Tots
there.
lost. There
I
you
will
go.
say, just to bring us ahead to the day that isn't necessarily having to do with football, we've got Bill Dudley, the former New York Fed president, joining us in about 90 minutes' time, talking about bank regulation at a time that's so delicate, where banks have really been the stalwarts of the financial system coming out of the pandemic, right heading into earnings, talking about their profits at a time when there still is this K-shaped recovery. Really interesting to discussion. Then at 1 p.m., I'm very interested to see the demand for this $38 billion sale of 10-year Treasury notes. How much foreign demand? How much domestic demand? How are the metrics going to signal? In other words, where are yields going to go? We've seen a really messy 7-year auction several times in a row. 10 years tend to be pretty calm. 1:45 p.m. Very interested to see if there is any bipartisanship on Capitol Hill. There is a bipartisan congressional meeting along with President Biden and Vice President Kamala Harris, where they'll be talking about that $2.3 trillion of fiscal stimulus. Will there be any agreement on paying for this? We do have, of course, Goldman Sachs coming out and saying that the potential for corporate taxes will crimp earnings next year in the equity market. How realistic are higher taxes, given some of the reluctance on both sides of the aisle to get this through, John?
Lisa, thank you. Another big debate down in D.C. Big debate here on Wall Street. CPI tomorrow morning. Your estimate, your median estimate, 2.5%. Really tight range here, Tom. 2.3 to 2.7 at the upper end of 2.7. Morgan Stanley, Citigroup looking for 2.7% year on year. This is the base effects, Tom. Just basic maths kicking in. Base effects. Does it go beyond that? You saw PPI on Friday.
Exactly.
Do you get anything more than what's expected?
Carl Riccadonna sent me a love note on Friday. Usually when Riccadonna sends me a love note, John, it means I'm wrong.
What did he say?
What a shock. He said, look, inflation's way out. I mean, right now we're all seeing the base effect. And what are we going to see about the worries, the doom, the pendulum of cost dynamics,
Lisa's new pendulum of cost dynamics. Did you see the gold price action on Friday? So to borrow Abigail Doolittle's words, we had a hotter than expected print on PPI and then went straight to gold. What happened to gold? It was down on the session. It was down on the session, Tom. Gold's down on the year too. So in a year where we're all discussing... Exactly. In a year where we're all discussing higher inflation prints, what happens to gold, Lisa? Lower. What happens to Bitcoin? It has been ripping.
Yeah, the new digital currency, that basically the macro hedge, as we heard from Troy Gajewski of Skybridge on the idea of monetary debasement, whether that actually fuels something that is lasting into 2023. Another question, John.
Let's get straight to David Kotok right now, Cumberland Advisors CIO. David, let's start right here. I want to start with Tuesday morning. You're with us now, but let's pretend it's Tuesday. We're about 90 minutes away from a CPI print. How do you trade around that number? How do you invest around the inflation dynamics that you expect this year?
John, we're fully invested. We have been fully invested for a while. We think the stock market heads higher, and we think Carl Riccadonna is absolutely right. Inflation expectations up, inflation coming, not so much, and there are reasons why. You can't get inflation without intensifying aggregate demand and rising, accelerating labor costs and a credit multiplier in a banking system. We don't have any of the three. We've had a big shock. We're coming away from a shock. It's a huge shock. It's not a normal business cycle.
The shock here is when he's not fishing down in Florida, folks. David Kotok is the most measured newsletter writer I know. With Cumberland Advisors, it's real simple. Often he is in cash. Often he is scared, and you're not scared right now. What are we going to hear, David Kotok, from American earnings season, revenue season, and the expectations forward?
Big numbers. First quarter, we're going to see the banks. You talked about it. They're coming. They're going to be strong. They will be comparisons. There'll be a lot of analysis. But if you look, Tom, at the American banking system, which is resilient, strong capital, great supervision, because it went through the shock of the financial crisis only 10 years ago. We saw a hedge fund blow up, no long-term capital impact in the United States. We saw a bank like J.P. Morgan say, we don't want any parts of this hedge fund. We saw Wells Fargo not scathed. The damage was done in Nomura or Credit Suisse. It was not done in American financials. We're the stalwart financials of the world now.
David, how much is your view on being bullish on risk assets predicated on an idea of rates remaining low for a long time, based on this idea that inflation expectations have already gotten ahead of their skis and that we are likely to remain in this lowflation world for a very long time?
Well, look, we think that's the case, Lisa, and there's a reason, a quick summary of the reason. We were 153 million non-farm payroll in February of last year before COVID. We're back to 143 now. You have to go back 5 years to get 143. The trajectory of rising 2 million a year would put us normally at 157. So look at the gap. Look at, you talked about it earlier, about labor participation rates. Look at the gap. So if you have this huge gap, number one, and you have years of lives lost because of deaths from COVID, roughly 9 years of lives lost for each death after you adjust for older people in nursing homes. What have you done? You've taken this big chunk of aggregate demand and removed it. It's not there anymore. And it has to be refilled. So I think the inflation pressures are coming at the second half of this decade. And I think personally, Jay Powell and the Fed have been doing the right thing. And if anything, they will have to do more. And most importantly, fiscal policy will have to do more, because that gap is so large and it has to close. That's our view. We're fully invested. We have a productivity gain from COVID, and the outlook is good. Earnings, $40+ for this quarter, $200 for the year, and rising at a compounding 7-8% for the decade.
Someone had a good catch over the weekend, that's for sure. David Kotok sounding very, very optimistic about the future. Good to catch up, David. Good to see you, sir.
Nice.
Couple of advisors, CIO, very optimistic. But on one thing, maybe you could frame it as less constructive, Tom. The idea that the Federal Reserve is going to have to do more through this cycle than it's already doing is a big call.
Well, it's a big call, and when you start to add up the stimulus, just the normal budget lift you get, nobody faults 118 billion or whatever it is. You've got stimulus 1, stimulus 2, 3, 4, whatever they are, John. Add them all up, and I came up with a real quick $4 trillion statistic. So I'm not sure how much the Fed has to do.
And now we're talking about what? A labor shortage in the United States of America, potentially
widely
through
understood.
the summer. Yeah.
Well, temporary, perhaps.
Will it persist? And what will wages look like in the back half of this year? Bill Dudley joining us, former New York Fed president. Looking forward to that conversation in about an hour and 20 minutes. In your bond market, 166 on 10s. Euro dollar 119.10. In your equity market, all-time highs. We pull back by 0.1%. Heard on radio, seen on TV. This is Bloomberg Surveillance.
With the First Word News, I'm Rishika Gupta. Fed Reserve Chair Jerome Powell says the U.S. economy is at an inflection point. Powell told the CBS program 60 Minutes there's a strong growth and hiring ahead thanks to rising vaccinations and powerful policy support. But he warns that the coronavirus is still a threat. Powell says it's going to be smart if people could continue to socially distance and wear masks. Today, congressional Democrats will start considering President Biden's $2.2 trillion spending and tax proposal. It's up to House and Senate leaders to determine how to package the president's proposal. His American Jobs Plan focuses on infrastructure and some social measures. The president is expected to ask for another massive investment in programs focused on health and families. And regulators in China have told Ant Group to become a financial holding company that could be regulated more like a bank. That's their first significant guidance for the financial technology company since they halted Ant's record IPO. The People's Bank of China also told Ant to rectify unfair competition in its payments business and to end information monopoly. Microsoft is making a massive bet on healthcare artificial intelligence. Bloomberg's learned the software giant is set to buy Nuance Communications in a deal with an equity value of about $16 billion. Microsoft has been working with Nuance on AI software that helps doctors capture patient discussions and integrate them into electronic health records. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
Model minority myth wasn't something that was fabricated by the Asian Americans. It was created as a tool to alienate the Black and the Asian American communities, and it was incredibly successful.
We know the racism didn't begin yesterday. We know it's probably not going to end tomorrow, but it is our job to make sure that there's progress and we keep people safe, give people dignity.
And I spent a lot of time last year to just listen, to understand, to reflect, and understand what I could do as a leader of this organization.
For many years, we've been very shareholder focused, and now there really is much more of a community requirement.
The economic downturn in the U.S., we're seeing unemployment and income losses affecting women more than men.
2/3 of the jobs lost in South Africa were women's jobs. So I think we're in a moment of crisis.
Clearly, our societies are reproducing, not reducing inequality.
We need better public policy and we need companies to step up.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
What we're seeing now is really an economy that seems to be at an inflection point, and that's because of widespread vaccination and strong fiscal support, strong monetary policy support. We feel like we're at a place where the economy is about to start growing much more quickly and job creation coming in much more quickly. So the principal risk to our economy right now really is that the disease would spread again.
Show me the data. Chairman Powell of the Federal Reserve speaking to CBS 60 Minutes yesterday evening from New York City this morning. Good morning. Alongside Tom Keene, Lisa Abramowitz, I'm Jonathan Ferro. Here's the price action this Monday morning. Equities pulling back a full 5 points, down 0.13%. We pull back from all-time highs on the S&P 500, 41.14. In the FX market, euro firmer. The vaccination data in Europe gets a little bit better. Euro dollar 119 handle at 119.12. In the bond market, your 10-year yield unchanged at 166. Your CPI print 25 hours away. And Tom, I have to say credit where it's due for the Federal Reserve. We've had, 75 basis points repricing, yield higher on a 10-year in America, and they didn't lose their nerve. They talked about this being consistent with the outlook. All the conversations we've had about the prospect of yield curve control, a Fed that would need to step in as yields repriced higher, that hasn't happened. It did not happen in the last several months.
And within the churn, whether it's euro sterling or you've got a euro-centric, europhilic recovery and stronger euro, same thing in the rate space where the real yield says we have not seen the kind of shift many are predicting, which is a lesser negative, a higher real yield, a trend back towards zero, negative 0.67 right now there. On Washington, Emily Wilkins, our Washington correspondent. Emily, good morning to you. I want you to define right now the sum of all the spending that's going on. Has anybody sat down, in the pandemic sanitized Willard Hotel and actually added up what all the spending will be?
I mean, it's going to be a lot. I mean, the size of the bills that we're passing, this $2.25 trillion. I mean, just in scope of legislation that Congress has passed, this is easily one of the most expensive bills we've ever seen, which is why there's so much debate at this point about how to pay for it and how much needs to be paid
what is
for.
The debate? Emily, I don't mean to interrupt, but what is so important here is over the weekend I couldn't figure out what the adjustment is. Do you perceive 2.x trillion down to 1.9 trillion, or do you see it down to something much, much lower?
Well, another thing to keep in mind, Tom, with these numbers is that 1.9 trillion was sort of for an immediate sort of stop the bleeding, address the emergency items of the pandemic. The 2.25 trillion, you got to think of that over the span of the next decade, because this funding isn't just going to be for now, but it's going to be for further down the road. And I think one of the things the Biden administration wants to do is make sure they really do have a strong recovery from this pandemic. They don't want a sluggish recovery like we saw from the 2008 recession.
Meanwhile, President Biden has announced a lot of ambitious plans in his first 100 days. A lot of people have said he's done a lot more than other presidents pretty quickly. Is he actually doing more, or is he announcing more? In other words, if you take a look at what's actually getting done.
Okay, traders, I've got to cancel the order to sell short Bitcoin. As you can see, it takes too long to fill this order, and it's looked like it changed direction of movement. So all of you guys who wanted to sell short Bitcoin, please cancel your order, and I'll let you know later on if we'll be able to get the good price for you. Okay, so the order to sell short Bitcoin was cancelled.
COVID package. This is when you're really going to start seeing lawmakers pushing for what they want, being stubborn about things. I mean, every Democratic lawmaker on the Hill right now knows if you're in the Senate, it just takes one. If you're in the House, it only takes a small handful to block any sort of legislation that passes. That's an immense power for lawmakers, and that's something that they're going to be using to try and get their priorities in this upcoming infrastructure package.
Emily, how much pressure is there to break this bill up into pieces that are more palatable for a greater number of congressmen?
That's such a great question, Lisa. And that's something I think that we're going to be seeing determined in the next couple weeks. Remember, lawmakers are just getting back to Washington now. They've been gone for 3 weeks in the House, 2 weeks in the Senate. They're finally going to be back, be in the same rooms and say, okay, look, exactly how is this next part going to go? Because you have seen some senators, including Senator Joe Manchin, say that, look, this all needs to be one package. But you've also heard House Speaker Nancy Pelosi suggesting that it could be 2 packages or more. So I think it's going to depend on what strategy they have. I think it's going to depend on how much consensus that you have among Democrats. I think it's going to depend on whether they think they can actually get some Republicans on board for sort of the more traditional infrastructure pieces in this legislation. So I think there's a lot to keep in mind. And I think today and tomorrow, when lawmakers finally get back to Washington, we're going to start getting a much better idea of what the next several months are going to look like and what's going to be in a final package.
And let's just take that final part. Getting Republicans on board. Emily, how seriously are you taking bipartisan talks?
That's such a great question, Jonathan. I mean, you are seeing Republicans go to the White House today, and it's kind of interesting because they're not the usual culprits. It's not your Mitt Romneys and your Susan Collins. It's lawmakers who are a little bit further to the right than that, a little bit less willing to compromise with Democrats. And yet President Biden has decided that these are the individuals that he's going to meet with, either because they've shown an interest in infrastructure, because of the parts of the country they represent. So it's an interesting tactic here, but also remember what the White House has done with previous legislation, particularly the COVID package. Yeah. They've defined bipartisan as not bipartisan as on Capitol Hill, but as bipartisan with Republicans throughout America. That includes local leaders, that includes voters, and that's something that I think you're going to continue to see President Biden make his pitch to those individuals.
Yeah, Tom, we heard this, didn't we, from the president himself? I think he talked about uniting the country and not necessarily uniting Congress. And what we saw last time around was bipartisan talks, invited Republican senators into the White House to talk about a relief bill. And guess what happened? Nothing.
The polling is the polling. I can't say this enough. Gallup, I know, is on top of this, and a number of other pollers as well, how far removed some of Republican leadership and the troops in Congress are from their constituents on stimulus.
Yeah, Emily, it's pretty clear. The electorate was all behind what happened in the last couple of months around infrastructure. I'm sure if you just said to someone on the street, do we need to spend more on infrastructure, they would say yes, and that would look good in the polling too. When it comes to the specifics, Emily, I think there's a big conversation about that. What in this is actually traditional infrastructure? What in it is social spending, a Trojan horse and a Republican talking point for everything that maybe Democrats want, a wish list, so to speak? And what is it about this particular plan that really takes on what the president has called a competitive China?
I mean, let's be honest. There are some things in this bill that you could argue are infrastructure, and then there's some things in this bill that it would be difficult to make that argument for. But at the same point, Democrats are saying, look, we won the House, we won the Senate, we won the presidency, and we did it because of certain policies that we can get through in this bill. They're looking at infrastructure by looking at the workers as well here. So yeah, I have heard those arguments for Republicans. You're probably going to continue to hear those arguments for Republicans, but it doesn't mean that there won't be things in this package that Republicans could feasibly support. The question is, will it be taken out or put in one giant lump together?
Those margins in the House and Senate are tight, tight, tight. Emily, good to catch up. Emily Wilkins there of Bloomberg Government, alongside Tom Keene, Lisa Abramowitz. I'm Jonathan Ferro. All-time highs in the equity market. How many times did we say that last week? Your S&P 500 right now down 1/10 of 1%. 10-year 165.86. Yields unchanged. On radio, on Bloomberg TV. This is Bloomberg Surveillance.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
From New York City for our audience worldwide, live on TV and radio, this is Bloomberg Surveillance. Look out London for volume through the trading day and the trading week as the pubs reopen in the city. You think I'm joking, I'm not. Look out for volume here stateside, that's been low too. Futures right now, S&P 500 futures down around about 0.1%. NASDAQ futures off by 0.2%. Talked a lot about the outperformance on the NASDAQ. You saw that last week, up by almost 4 percentage points on a week. The Russell was actually lower on the week. That's some big outperformance. Right now, the Russell outperformance, relatively speaking, looks like this. negative 0.04%. Switch up the board and get to the banks. I want to talk about the banks and what we've been hoping to see this year. Higher yields, you got it. Better outlook, you got it. Now it's about the data. What is the source of surprise this time around? Upside surprise? Did the banks get that? The banks on Wednesday. Look at this year to date. Up 23%, JP Morgan. Bank of America up 32. Wells Fargo up 34. Brilliant numbers, performance so far. And participating in that bank rally, also Europe too. And the vaccinations in Europe really starting to improve. So where is the relative bar for performance here? Where'd you get that upside surprise?
John,
Got a comment, Tom?
I go to Tony Dwyer, and
what's Tony say?
You get negative if you see a recession out there. Do we see a recession out there? I don't think so.
I don't see we see a recession either. I'm not talking about getting negative. I'm talking about relative performance here, Tom. Europe versus the United States, say. You've got a comment on London and the pubs reopening.
No, I do. I mean, I stopped by the Carlisle to see when Bellman's opens.
I was waiting for that.
There's like a, you know, it's like the same thing. In London, it's the pubs, and here it's the Carlisle.
Apparently, it's freezing. It's snowing. You see, that's the difference between you and I, isn't it? You go to the Carlisle, and I would go to the pub. Yeah, London, New York, and have very different lives.
Even more importantly, John, Romain will go to both.
Romain would go to both. We'll get to Romain in just a second. Let's finish on this. In the bond market, Lisa ran you through the supply. Tons of supply through today and through the week as well. 10-year, 3-year, a little bit later today. Your yield right now, 166.40 on 10s, on 30s, unchanged at 132.94. I like to think Romain would be in the pub with me, Tom, and not in the Carlisle with you. I think he's that kind of guy. My kind of guy, not your kind of guy. I think he comes to the pub with me. Romain, what do you think?
All right, well, don't make me choose between you two. You're both my favorites here.
Here we go.
Well done. Let's look, a big week here for markets, guys. Of course, we have earnings, which you're just alluding to, with those bank earnings. Obviously, a couple big economic reports. And, of course, we're starting the week off with a major deal here. This, according to people familiar with the situation. Microsoft said to be preparing a deal for Nuance. Now, people of a certain age might remember this company from a couple decades back. It had that Dragon voice recognition software where you can speak into your microphone on your computer, and it would basically allow you to dictate. That was a relatively revolutionary concept at the time. That company has since really gone a lot deeper into AI and voice recognition. Microsoft apparently wants this as part of a broader sort of health network that is trying to build here. This deal will be a $16 billion deal. Now, we should point out neither company has confirmed that this deal is in the works, but Bloomberg reporting this could be announced a little bit later today. And then Tesla, the hype train continues on that. Canaccord out with a note here basically saying, again, if you want to value it, don't value it as a car company. They're saying they're looking at it from the energy storage angle here and putting a pretty hefty price target on it. Flip up the board, just a couple quick names I want to get to here before you guys get back to it. Of course, you guys have been talking about everything that's going on.
Your thoughts on Alibaba and Ant?
Yeah, I mean, Alibaba and Ant, you guys have been all over this morning. Obviously, you got the fine for Alibaba, much lower than expected, but still a record fine nonetheless. But more importantly, you have Chinese regulators basically looking at Ant Financial, looking at that whole empire, saying, look, you can be a fintech company, you could call yourself a fintech company, but we're going to regulate you like a bank. That's really weighing on the shares of other companies in this space. Alibaba's up primarily because of that fine, or the less than expected fine. But when you take a look at Tencent, you take a look at Baidu, you take a look at a lot of the companies in that fintech space over there in China, all those shares, the Chinese or the Hong Kong shares, under pressure today. You're going to see them under pressure here today with regards to the ADRs. Yeah. A big issue going on over there in China. Uber, some pretty decent numbers. Well, decent with regards to the food delivery, something running at a run rate of like 50 billion on the year. Mobility business, still, that's basically the ride-hailing, Tom. That has not gotten back to those pre-pandemic levels. And before I go, Tom, what is going on with your tie, by the way?
My tie?
Yeah, it's very short.
Yeah, I know. I got to fix it, but I'm all wired in the background.
I love the idea.
Seriously?
Romain is giving Tom criticism of his bow tie tying.
All morning. It's been bothering.
Yeah, he needs to buy some more bow tie wax.
You know, I went to Target and got it, and, you know, I feel good.
Romain, you're welcome anytime. It's good to catch up. Thank you, sir.
You still
close
Romain,
a little bit later.
Romain, go away. The close this afternoon, and look for that, probably with the equity markets. Not the new record highs, who knows? Right now, and this is important, the White House moments ago out with the word du jour, President Powell, Chairman Powell mentioning it last night on 60 Minutes. White House expects transitory rise in inflation. How about your transitory transitory underperformance within the equity markets. Leslie Volconio is with UBS Global Wealth Management, and she makes a cottage industry of asset allocation, and very different from other asset allocators, writes detailed reports. Leslie, what is the UBS advice right now to the huge body of people who feel they've underperformed and been left behind in this market?
Well, I mean, one of the things is, we still are very, I wouldn't want to say overweight, but we don't think you should be cash on the sidelines. I mean, in the fixed income side, which is my specialty, I will say this. The market or the market expectations has pushed a lot forward. So that's why we've seen the sudden rise in interest rates. And there's no question that the opportunity set within fixed income is pretty narrow, and it's this balance between yield and capital preservation. But we do think there are pockets of opportunity for the longer term that people should be invested in terms of earning good carry and while maintaining that capital preservation.
But the agony, Leslie, right now of underperformance is maybe about focused investing, less diversified bets on individual securities and selected asset classes versus the good old institutional, broad, wider diversification. Which is the best path now?
Listen, I think diversification is always the best path. And now there's no question the traditional 60-40 split that we all know in terms of investing might have to be, rearranged a bit to maybe put a little bit more on the equity side than on the fixed income side, given some of the, headwinds that we might face from interest rates. But diversification, I think, at least in our opinion, is always the best measure going forward. And I think the one thing important to remember is what we're looking at is that, a lot is priced in the marketplace in terms of this, what we call these great expectations, right? A lot is priced in terms of what the market is expecting going forward in terms of growth and inflation. So I think one of the biggest things is to always, and because of that, it is important to remain diversified. You might just have to alter that 60-40 balance a bit.
Let's talk about altering that 60-40 balance. How do you alter it on the equity side, Leslie?
Well,
within the 60?
You probably increase a little bit more on the equity side. I mean, we all know, we've all talked about the correlation and the difference in the correlation between the treasury market and the equity side, right? Over the long term, the correlation should mean revert, but we've had, because of variables such as whether it's QE or fiscal stimulus, a little bit of break in that correlation. So I do think that in terms of that 60-40, what you do on the equity side, you'd increase the equity a bit. Now, if interest rates do rise more than we're expecting, which is not a lot, it's only about 2%, obviously when it comes to earning income on the fixed income side, the opportunity set widens. And you may have a different balance going forward. But right now, we think it'd be leaning more towards the equity side than on the fixed income side.
The reason I asked that question, Leslie, is because I caught up with BlackRock a couple of months ago, who were also thinking about the same dynamic. I think many of us were. And what they said is maybe you could make the equity composition a little bit more defensive to allow you to take a little bit more risk on the bond side of things. Where would you come down on that particular argument?
Well, listen, I think that how we're positioned right now, only because we do have a positive outlook. We're a little bit more pro-cyclical, I would say, on the equity side, and also a little bit on the fixed income side as well. I mean, we have a tendency to lean on the fixed income side more towards things like senior loans, which do have a higher correlation to the equity market than just say your traditional fixed income, high-grade fixed income like investment-grade corporates. So I do think there's a way to have this balance, but right now we're still a little bit on the pro-cyclical side because we do think, although expectations are very high, going into end of 21 and 22, we'll still have this sort of reflation trade continue.
Leslie, I keep thinking Goldilocks. This seems very Goldilocks. We've got low rates that are expected to remain relatively low for a long period of time with really solid corporate earnings. How long can we stay in this Goldilocks before either rates go materially higher or corporate earnings come down materially?
Well, listen, I think the guidance from the Fed is that they have no intention of draining this punch bowl anytime soon. And I think that they reiterated that they will keep interest rates low for a period of time, and in our opinion, maintain QE for a period of time. Of course, that can't go on forever, and you're absolutely correct. Now, when that time comes, when it switches, it's very difficult because we really need to see the data in the second half. Right now, it's about projections. We need to see the data. And, it's a little bit too difficult to predict what's going to happen in the second half. We think interest rates will rise, not materially, maybe just to that 2% level. But if, in fact, the data comes out much stronger than what's anticipated and the Fed waits too long, where they have to not just push their hiking forward, but the magnitude of the hike is greater, that could cause a bit of a catalyst. Right now, that's not in our baseline framework, but it is a possibility until we do see the data.
Leslie, good to catch up with you, as always. Come back soon. Leslie Falconio there, UBS Senior Strategist. Just moments ago, we had a blog post put out, led by Jared Bernstein of the White House, a individual who's come on this program many times, both in this position and in his previous life too. Here's the title, Pandemic Prices Assessing Inflation in the Months and Years Ahead. And the highlight, Tom, effectively is the White House saying what they expect to see in the next couple of months will be transitory. And I think it's really important to understand what's going on here. I think here's a White House right now looking to control the narrative around the next several months. Why? Because they're looking to do a whole lot more. The last thing that they want is for media organizations and individuals, the public, the electorate, officials down in DC to run away with this idea that it's anything but transitory and then really hinder their effort to do even more in the months and year ahead.
It doesn't have anything to do with tomorrow we get CPI.
I think it has everything to do with that.
I think they're.
But that's the story, Tom. How do they control what the messaging looks like outside of that?
They don't.
They can try and shape it.
In Europe, we saw a lift here in some PPI statistics this morning. I think you're going to see it in the United States, and the markets will react to it as it always does.
And the officials will come pouring out, Lisa, to tell us what?
Transitory.
That it's transitory.
Well, and they're not alone. I mean, I was looking actually at Hoisington Investment Management, a longtime bond bull that has actually gotten it right again and again. And they said they expect the psychosis, that's what they called it, around inflation expectations to wane and actually disinflation being a greater threat than inflation. Honestly, they are not alone. So perhaps it is a lobbying point and messaging. And yet there is an underpinning to their logic.
The CPI, 8:30 tomorrow morning. 8:30 this morning. In about 50 minutes' time, we'll catch up with Bill Dudley, former New York Fed president, alongside Lisa Brabbits and Tom Keene. I'm Jonathan Ferro. Your S&P 500 pulling back from record highs, 41.14. We're down 1/10% in the bond market. Yields up by almost a basis point now to 166.40. And euro-dollar firm up by about 1/10% in the euro's favor, 119.10. Heard on Bloomberg Radio, seen on Bloomberg TV. This is Bloomberg Surveillance.
With the First Word News, I'm Rishika Gupta. Fed Reserve Chair Jerome Powell sees stronger growth and an improving labor market ahead for the U.S. But he tells the CBS program 60 Minutes the main risk is that the coronavirus would spread again. Powell also said the Fed would do everything it can to support the economy for as long as it takes to complete the recovery. In Hong Kong, the government may relax some social distancing measures if more people get their first coronavirus vaccination. Restaurants may be allowed to extend closing times from 10 p.m. to 2 a.m. and bars and nightclubs could have limited reopening if all staff and customers have received their first shots. Iran blamed Israel for an attack on the power network at its largest uranium enrichment plant. That comes at a time when diplomats are trying to revive the international deal that contained the country's nuclear program. Iran says that centrifuges were damaged at the facility. Israel is neither confirming nor denying its involvement. In Germany, Chancellor Angela Merkel's Christian Democratic Union has backed party chairman Armin Laschet as the Conservative bloc's choice to succeed Merkel. That sets up a potential clash with the Christian Democrats' smaller sister party, whose chairman also wants to run. The election is set for September. Bitcoin approached an all-time high today. The world's largest cryptocurrency crossed that $61,000 threshold level at one point, just shy off the record set last month. The biggest U.S. cryptocurrency exchange is set to go public on Wednesday. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
Asia is absolutely core to our business. It's almost 20% of our franchise revenues globally, which is significantly more than most of our global peers who are more in the mid-teens.
We want to invest, grow in China, but also we are also investing in the rest of Asia as well. Our top line growth for the region has been close to 24% last year, almost 20% of the group's revenue as a percentage of the revenue of the group. So, and this is where the group is counting on the growth.
We see company after company, these are corporates committing to net zero. So pretty much across the board, there is an enthusiasm for putting capital to work to try to get us to a better carbon future.
Credit Suisse has a fantastic brand name in Asia. We have obviously strong positions in Singapore and Hong Kong as our two main hubs, but across the region.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Trading revenues coming in better than expected. Everything. Cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Start your mornings with Bloomberg Surveillance. Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Extraordinary market day.
This rally just keeps on going.
But there is a tipping point.
The business team you love to watch. Weekday mornings on Bloomberg Television.
Authorities are actually tightening liquidity because economic recovery is firmly on track. They want to control the leverage ratio. They want to control the risk of overheating. So therefore, as they really reining in the credit growth, you're seeing some softening of the mainland markets.
Certainly seen that so far over the last month. That was Yin Gilroy there, JP Morgan Chase Managing Director and Vice Chairman of Asia Pacific. From New York City this morning, good morning. Alongside Tom Keene, Lisa Abramowitz, I'm Jonathan Ferro. Here's the price action right now. Equities pulling back from all-time highs. We're off by 0.16%. It's a mild move lower this morning ahead of a really interesting trading week. CPI tomorrow, retail sales Thursday, JP Morgan earnings kicking off bank earnings on Wall Street this coming Wednesday. Outside of that, euro dollar 119.11, yields up a single basis point, 166.57 on 10s. You'll get some supply a little bit later. And Tom, let's finish on this one. We opened up this particular conversation by mentioning China. Alibaba with a record fine from the regulator and the hope, well, here's the relief in the market. In the pre-market right now, Alibaba ahead of the US Open up by a little more than 6 percentage points. The hope that these issues are behind the company now.
Yeah, I'll give the relief there, John, but I thought there was a wide set of headlines there that really show a new China as well. Joining us to drive forward the conversation and occur, and more than our chief Asia economics correspondent, hugely perceptive on the political economics and the economic politics of the Pacific Rim. And I really want to talk about something out of George Magnus's required read, Red Flags, where he talks about rebalancing and reform. Do you perceive that Beijing and Mr. Xi are rebalancing and reforming business over towards more of a state-owned enterprise?
Well, look, there's no doubt, Tom, they certainly are trying to get the tech sector in particular back into line. We've seen that over the weekend, like John mentioned there, with the 2.8 billion fine towards Alibaba. Alibaba are saying that, you know, they're putting the most of this crackdown, this regulatory crackdown behind them now. But China did also say through the state press today Tom, that they are not all about stifling competition or innovation in the technology sector. This is kind of a reminder and a check on the tech sector, to get back in line, that you are supervised by the central government. They don't want them getting too big for their boots, but they're also trying to send a message because they know, of course, that they need the tech sector to grow their economy, and growing technology is a big part of China's ambitions over the coming years in a new 5-year plan. So it's a slap on the wrist and a reminder as to who's in charge, I think.
Andrew, I think they got the message, looking at the open letter from the company. And for our audience who haven't seen that yet, let me read some of it to you. This from Alibaba following that record fine. Alibaba would not have achieved our growth without sound government regulation and service. And the critical oversight, tolerance and support from all of our constituencies have been crucial to our development. And we said a little bit earlier, Ender, here's the line that you would not get from a US company, I don't think, facing regulatory issues here in America. For this, quote, "We are full of gratitude and respect." And are they just at the mercy of whatever the regulator wants? Can these companies do anything?
Yeah, well, there's no doubt. It's an all-powerful, centrally controlled administration in China, John. And when the regulators crack down on the sector, that's what goes. We know that Beijing has been intent on reining in the internet and the fintech giants. They've been pushing this campaign for a while now. It's taken off, in fact, more than 250 billion worth of Alibaba's valuation since last October. And in the case of Alibaba, they came around with a speedy capitulation, and I think others will do likewise, because the alternative, of course, is to risk an even tougher crackdown or even harder oversight. And as I mentioned, there's a view now that the worst of this scrutiny might be behind Alibaba. We saw a simultaneous move today on Ant Financial, by the way. That's going to be treated now more like a financial holding company, to be regulated more like a bank than a tech company. And that's another example of how China is trying to pull things into line. So it's a mix of regulatory oversight driven by genuine concern over keeping tabs on the sector, and of course then political control and making sure that all of these companies are on message and marching towards the same national goal.
And just as we think through this in real time, I would ask if there's a message here for foreign companies operating within China, but for the tech companies, for many of the big players, they're just not there. They can't get in. Do you think there's a message here for how they operate internationally as well?
Sure, I think there is. As you mentioned, Jonathan, look, the market in China remains very much closed to foreign companies in the tech sector. China has been opening up in terms of other sectors, especially the financial services sector. Wall Street is making inroads there. But of course, it does also speak to how these companies operate overseas. They are closely regulated by the Chinese government. Even if they are private companies, they do ultimately have to respond back to the oversight coming out of Beijing, and that definitely influences how they operate around the world. So it does speak to certainly a divergence in the system that China operates versus systems that are operated more globally. And I don't think there's any prospect anytime soon of China easing up on this regulatory overhaul in terms of blocking foreign competition in the tech sector, especially in its domestic markets. We know that as the US-China technology tensions get worse, there's little prospect of that happening.
And there's a question about messaging versus reality, and I think about that when it comes to leverage in China. The equities have underperformed in the region due to a supposed withdrawing of leverage by the PBOC, and yet there was data out today showing that China's banks lent a record amount of money in the first 3 months, and that leverage actually, or loans, increased. Is this a dissonance, or is this sort of a slowdown that is a justification for the weakness that we've seen in Chinese assets?
No, this is a great question. There is a lot of discussion going on around China at the moment that they do want to start tapering their support, that we know the economy is back on its feet since the pandemic first struck. But in fact, as you mentioned, China's banks are going gangbusters, a record amount in the first quarter. The central bank is having to warn now financial institutions to curb lending, but we haven't yet seen any major sign of a tapering, Lisa. We haven't yet seen any major sign of policy tightening per se. It's more warnings from the authorities, warnings from the regulators to keep this lending in check. They are keeping an eye on it. They are pursuing an overall restrained stimulus strategy this year, especially compared to other economies, but they haven't yet sort of explicitly or outright tightened either. And I think that's because they know there are parts of the economy that still needs a lot of support. The economy is still somewhat uneven. The recovery in the consumer side is lagging the broader industrial sector, for example. So it's kind of a steady as she goes. They're not going all out on the stimulus side, but neither are they pushing the the tightening button either.
The goal is stability, as always. And good to catch up, sir. And Karen, Bloomberg Chief Asia Economics Correspondent, on the economy in China right now and on the issues with Alibaba as they receive a $2.8 billion penalty from the regulator in China. A bit of a relief rally for the stock. That's up in a pre-market stateside on the US depository receipt, up by a little more than 6%. Here's a headline for you, Tom. Coming out of Germany from the team at Business Insider. German states agreeing to extend the lockdown by 3 weeks. That's still the reality of the situation on the continent at the moment, Tom.
You know, it's the moment, and it's the tough decisions they're making. You wonder what tough decisions we're going to see with the success that we're having of what do we do about people that don't want to get vaccinated. And within the liberty debate of America versus Germany, I would say it's two separate conversations.
Absolutely, Tom, in a big way. Coming up on that conversation, Tony Rodriguez, Nuveen Head of Fixed Income Strategy, alongside Tom Keene, Lisa Abramowitz. I'm Jonathan Ferro. Your equity market, 41.13 on the S&P 500, coming in a tenth of 1%. On radio, on Bloomberg TV, this is Bloomberg Surveillance.
This patch of land in northwest Saudi Arabia is going to become Neom, a city powered entirely by renewable energy. The government hopes the site, which is the size of Belgium, will be a clean energy hub, not only for the kingdom, but also the world.
This here is at the borderline between Mission Impossible and Suicide Mission. Lucky enough, so far we've just been on the right side of the line, yeah. But you know, it's very close to that. You know, this is just smoking. This is nothing ever I've seen or heard of the dimension, the challenge. You know, I'm not talking energy only. You know, but in its broadest context, including the geopolitical dimension, including the cultural dimension.
Neom will include a $5 billion hydrogen plant run on wind and solar energy. All of the zero-carbon fuel it produces will be shipped to international buyers in the form of ammonia. When it starts operating in 4 years' time, it will be one of the biggest hydrogen facilities in the world.
Can't explain Neom on the back of a set of PowerPoints and a video clip. You just need to be here. You need to, breathe it. And specifically the startup mode and, things happening. Buses all around you here.
Madame Lagarde, has the balance of risk actually shifted since the last policy meeting?
Well, our balance of risk is still tilted to the downside in the short term, but it is much more balanced in the medium term.
What are markets exactly playing out at the moment? They seem to be continuing testing central banks.
They can test us as much as they want. We have a mandate, we have an aim, we're going to be riveted to that, and we're going to do what is required.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
And fight against climate change, Bloomberg Green has you covered.
Is definitely coming under control. Economic activity is actually returning to normal.
There's kind of still this catch-up that's happening in correcting for the COVID shock.
We are to some extent flying blind here. This pandemic is quite different than the financial crisis.
What the Fed would be afraid of is that people start to behave as if the money is burning a hole.
Personally, Jay Powell and the Fed have been doing the right thing, and if anything, they will have to do more.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene, a simulcast, Bloomberg Radio, Bloomberg Television, and John with a mega lift we got Friday afternoon. I'd already checked out, but, you know, it was a real move Friday afternoon, and the theme of it, the bull case continues this Monday morning.
Yeah, you checking out early on a Friday, it's not a shock to me, but the bull case does continue, and I think Peter Chew of Academy Securities asking the right questions this morning over the weekend. It's not about whether we'll get a boom. We're getting a boom. It's about how big will the boom be and how long will it last? And they're the questions we'll be debating now for the next couple of months.
What's so important here, John, we heard it from David Kotak on the equity market earlier. We're going to hear in a moment from Mr. Rodriguez of Nuveen on the bond market. We've got a lot of strategists on the same page of good, if not great, movement forward.
High yield spreads, tight. Cycle tights of the previous cycle, Tom. We're already through them. And what are we in? A couple of months into 2021. It isn't that the story. We've already seen these big moves in this market before this recovery's even got started. We'll talk about inflation tomorrow. Yeah. I'm already thinking about retail sales this coming Thursday. Those numbers are set to be big, Tom, large. I mentioned Bank of America looking for 11.5%. Our good friend and colleague, Carl Riccadonna over at Bloomberg Economics, looking for something in and around 10. My good friend, Lisa's good friend. Don't know if he's your good friend, but he's looking for something about 10% maybe Thursday morning, Tom. And they are big numbers that we could see for the next several weeks and months, too.
What's so important about this, Lisa, when you split apart yield dynamics, it's about a belief in all is good in America in a credit quality that maybe we've never seen.
I'm struck by the lack of visibility, especially in this area, the dynamic of inflation and the concept of transitory. And your conversation with Vice Chair Clarida, excellent on Friday, really highlighting that they're hoping to wait. They think they can wait. They think they have the tools to address inflation if they get it wrong and it heats up too much. But Tom, I'm struck by labor shortages. How much are these transitory? I'm struck by supply chain disruptions, again, ongoing, with some of the shipping costs remaining at the highest levels ever and expected to increase from here over the next 12 months, Tom. How is this going to translate into transitory?
Nicely said. It's the third time I'm sipping.
Wait, was that English?
We're playing the drinking game.
We're playing the drinking on radio.
It's the transitory drinking game.
I'm having my third sip, my God, and just think, no celery
and drink
today.
at the same
What's
time.
What's that about? John, what's so important here about transitory, and this, you know, we're making a joke about it, but there's a bet here. It's a bet made by the Fed, and John, in this show, it's a bet made by the White House.
It is, and Jared Bernstein out with a blog this morning from the White House leading that effort, saying that it will be transitory, and I think that's an important conversation that the White House has got to have in the coming months as well, Tom. They want to shape the narrative. They want to shape the narrative because they've still got some work to do, and one of those big efforts is around the infrastructure bill, and if you start to see a conversation around inflation, run away from them, run away from this transitory debate, and we start talking about something a little bit more sinister, I think it gets harder to spend more money at the Treasury. It gets harder for people to support them. I see what he's doing. What is in that car?
Real quick.
Anyway, Tom, I think it gets more difficult for them. And the big question that we asked on Friday is when this Federal Reserve, I'm trying to finish an important, serious point.
Question. John, the question is, with a Bloody Mary, do you lead with gin or do you lead with vodka? Which do you think?
I think you lead with gin. Okay. I'm a gin kind of guy.
I think you lead with Tony Rodriguez.
I like gin-based cocktails, and
please say
that's probably what I need right now,
say
too.
Something, please.
Tom, can I finish? Can I finish?
Please, just finish.
When we spoke to the Vice Chair, Richard Clarida, on Friday,
we did.
I think the important point of that conversation was, how will they know when they're wrong? How will they know if they're wrong? And they won't know the answer to that question, at least from Rich Clarida's point of view, from the Vice Chairman, until year end.
Yeah, well, year-end is out, past the second quarter, and I think what earnings is about this week is getting visibility to begin the percolation into Q3 of this year. John, let's get through the transitory data here as quick as we can. -8 on futures. To me, it's not much of a pullback from where we were Friday.
Let's do that right now. All-time highs in Friday's session, putting back 0.2% on the S&P 500, 41.12 on the S&P 500. When these year-end forecasts were put out at the back end of October, in early November, 4,100 just felt like a moonshot. 4,300 over at Goldman just felt ridiculous. Year-end. Made huge headlines. And here we are now, 41.12 on the S&P. Right bang on the money of UBS's year-end target. I think this was Goldman's mid-year target on the S&P 500, Tom. And a year-end just a couple of 100 points away.
Yeah, and oil printing $58 handle early this morning as well. Quiescence in the commodity market as well. As we mentioned, Mr. Kotak and optimism about equities. Tony Rodriguez is with Nuveen with years and years of work. And what's wonderful about Tony's work, it's really been focused on the corporate side and investment grade. His tenure at Credit Suisse of years ago. Tony Rodriguez, you are ever optimistic here about the credit quality that's out there. Do we underestimate the goodness of the balance sheet of corporate America?
Well, good morning, Tom. Good to be with all of you guys. I do think that there is some underestimation of the quality of the balance sheet. I mean, we are looking at Nuveen this year at 25% or higher earnings and cash flow growth. And when you look at what companies did basically throughout 2020 was they really fortified their balance sheet. They borrowed a lot, but they kept a lot of cash on their balance sheet. So what we're expecting to see this year, both in the high grade space and the high yield space, is a significant pay down of that debt, where you might get one full turn of leverage decline this year in the high yield market. So balance sheets are going to be very healthy in our view. And from that perspective, you can look at the pricing in the high yield market. Yeah. And while we certainly think it's pretty full, we think that it's justified by the reality of the improvement in the fundamentals.
John, I'm going to suggest that's something new here, to see that gross pay down that we see. And we saw it from Jim Suva on Apple, where he says they're going to really come in with a vengeance on buybacks and dividend increase.
It's to see leverage come in. But then in the high yield space, look at the story right now. United Airlines out this morning, kicking off a $5.5 billion high yield bond sale. We've had a ton of supply, and the numbers this year are set to get bigger, Tony. And the numbers are one thing. What that money is used for is another, and you've touched on this. How much of that is just refinancing?
Well, we're seeing the numbers that would indicate something like 70 to 80% is refinancing. So companies have been able to extend out the debt, which is clearly very critical in case you run into some sort of liquidity hiccup and inability to finance. But in addition to that, by paying down some of the cash that they built up, given all the uncertainty they were facing in 2020, now that really starts to bring down the leverage. And that's a big reason why we see default forecasts, not only our own, but rating agencies, other street firms, bringing them down to numbers that in many cases are as low as 2% defaults on a trailing 12-month basis by the end of this year. Those are almost record lows.
Tony, this makes sense when you look back 6 months, but there seems to be a cognitive dissonance a little bit when you take a look at the $1.6 trillion of high-yield debt outstanding in the United States. And you look at that, it's near a record high, that if you look back beyond the immediate pandemic times, these companies still look highly leveraged. Is there some sort of reckoning that is waiting for these companies past this era when they actually have to start paying this down in real time, not just paying down some of the borrowing that they did during the pandemic times to stay alive?
Yeah, well, when we look at kind of long-term averages of debt to cash flow, and you look at the high yield market and you say maybe it's 4 to 4.5 times debt to EBITDA market, we see numbers coming back down into that range, meaning the long-term historical average range. So what that tells us is that the overall high yield market is really not, we don't believe, a significant risk of dislocation just from the level of debt. The dislocation would come really more from a surprise in inflation, a much weaker growth outlook, potentially negative outcomes on whether it's the vaccine or resurgence of COVID, more of a fundamental driver of weaker growth. But from a financial stability perspective, the high yield market is pretty well positioned in terms of level of debt and where cash flow is, and where companies have been able to restructure their balance sheet to extend out their maturities, kind of pushing back any near-term maturity wall that is often a big risk in the market from a liquidity perspective.
Tony, just a final question for me before we let you go. Margins could be an issue this year. And margins will be in focus in the next couple of weeks when we get the earnings as well, on the cost side of things. How closely are you looking at that right now, Tony?
Well, very closely, and we clearly expect there to be some cost pressures, particularly here in the middle of the year as we head into towards the end of the year. All of the supply bottlenecks that you guys have highlighted, some of the initial reopening price pressures, whether it's from not only a goods perspective, but also obviously from employment, bringing people back in quickly enough to match what we think will be a big surge in services demand. So we'll be looking to see whether that is truly just a transitory short-term bulge in those pressures impacting margins negatively, and what the outlook will be for 22. Right now, our view is that the margin pressures will be transitory, and in 22 you get back to an equilibrium level of really still pretty supportive margins from a debt perspective.
London getting drunk on this program quickly. This drinking game's taken off, isn't it? Tony Rodriguez, Nuveen, head of fixed income strategy. That would be a game. You take the Bloomberg anywhere down to the pub garden as things reopen in London. Transitory, Tom, your buzzword of the morning and maybe the week.
You want another buzzword?
Tom,
How about
always.
Kindle?
Yeah, there you go.
While we were talking to Tony there, great conversation. IBM out. John, I remember the day that Jerry Tsai named American Can Primerica. And we were all like, Primerica. IBM has
got a headline.
What's
going on?
It's a Kindle. IBM has announced that their slower growing infrastructure business, they want to get rid of it, is going to be Kindle.
And it's going to be headquartered in New York City.
Yes, that's a good, we like that.
We do like that. Well, you think about the broader story in New York City, Tom. What did that conversation look like 12 months ago? No one's coming back.
It's all going to, yeah.
Companies will leave.
Totally take your point.
What's the feeling now?
Cash.
What's the feeling now in New York City? Everyone wants to come back.
Kindle.
Kendrill.
Do
Just taking a dig.
you know how many MBAs it
You know,
took to come
the
up with that
marketing
name?
team at IBM right now is loving you so much.
Can you imagine the
They're
number of
thinking,
consultants
we'll change
they
this
had?
unit's name. We'll just slip it under the radar. No
It's
one will notice.
transitory. The name
No one will
Kindle is
notice.
transitory.
Tom just
dear
comes out.
Lord. Yeah.
Kendrill. Coming up, Greg Valliere, AGF Investments Chief US Policy Strategist. You get that drink down your tongue. Transitory, transitory. We get you drunk early this morning.
I think that ship sailed.
Equities down 7. We're down 0.2%, pulling back from record highs. This is Bloomberg.
Maybe Kindle can get naming rights to Tottenham.
With the First Word News, I'm Ritika Gupta. Fed Chair Jerome Powell says that the U.S. economy is at an inflection point. Powell told the CBS program 60 Minutes that there's strong growth and hiring ahead thanks to rising vaccinations and powerful policy support. But he warns that the coronavirus is still a threat. Powell says it's going to be smart if people could continue to socially distance and wear masks. More than a dozen CEOs whose companies are desperate for semiconductors headed to the White House today to meet with the Biden team. The leaders of GM, Ford, and Google are amongst those taking part. Previously, the White House said there's no short-term fix for the chip shortage. Automakers want the Biden team to prioritize getting chips for their factories. And regulators in China have told Ant Group to become a financial holding company that could be regulated more like a bank. That's their first significant guidance for the financial technology company since they halted its record IPO. The People's Bank of China also told Ant to rectify unfair competition in its payments business and to end information monopoly. And Microsoft making a massive bet on healthcare artificial intelligence. Bloomberg's learned the software giant is set to buy Nuance Communications in a deal with an equity value of about $16 billion. Microsoft has been working with Nuance on AI software that helps doctors capture patient discussions and integrate them into electronic health records. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
travel minority myth wasn't something that was fabricated by the Asian Americans. It was created as a tool to alienate the Black and the Asian American communities, and it was incredibly successful.
We know the racism didn't begin yesterday. We know it's probably not going to end tomorrow, but it is our job to make sure that there's progress and we keep people safe, give people dignity.
I spent a lot of time last year to just listen, to understand, to reflect, and understand what I could do as a leader of this organization.
For many years, we've been very shareholder focused, and now there really is much more of a community requirement.
The economic downturn in the U.S., we're seeing unemployment and income losses affecting women more than men.
2/3 of the jobs lost in South Africa were women's jobs. So I think we're in a moment of crisis.
Clearly, our societies are reproducing, not producing inequality.
We need better public policy and we need companies to step up.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
We don't have a lot of work to do to persuade the American people that U.S. infrastructure needs major improvement. The American people already know it, and that's one of the reasons why there's such extraordinary Republican and independent and Democratic support for this package among the American people.
Pete Buttigieg there, the U.S. Transportation Secretary on Fox News Sunday. From New York City this morning, good morning. Alongside Tom Keene and Lisa Bramwitz, I'm Jonathan Ferro. Let's get to the price action of this Monday morning, kicking off a busy trading week for you. Tuesday, inflation, Thursday, retail sales, the banks on Wednesday reporting earnings. Going into that, futures down 7-8 points. We're down 0.2%, pulling back from record highs, holding on to that 4,100 handle on S&P 500 futures. Just remarkable turnaround in the last 6 months, a remarkable lift to this market. Yields up a single basis point, just a lift in the last hour or so on a 10-year Treasury. No drama, Tom. 167 on 10s. In the FX market, euro dollar 119.07, up around about 1/10 of 1%.
I like the idea, John, of no drama. That's really what it feels like, and there's a lot of information to come. Jack's watching. Thanks, Jack. Jack likes the idea that we're having transitory moments this morning.
Is that what Jack said? Should we
He just
at
wants an
least
extra excuse
let's
to
let the
take a
audience know
drink.
who are
It's
just
working
tuning
on
in what's
radio.
going on here. This is how it's going.
Please.
For the next 9 months, the only word you will hear is transitory, and it's become a drinking game on this
It's
program.
like V-shaped.
And in honor of London reopening and going back to the beer gardens, of course, these cups have something different in them this morning, and that's the game we're playing. So unlike one of us just being drunk every single morning,
All of us
Lisa and
will
I
be.
thought we might include ourselves in this effort too.
You know, Al from New Jersey, I think he's the one that lined this up. And, you know, I don't think it's 18 year. I think it's like 18 hour. I don't know. It's a little harsh.
Do you want to continue to?
Let's continue with Greg
apologized to
Vallier.
everyone.
Okay, he knows the drinking game at the Willard Hotel in London. You go into the Cozy Bar there, and there's 4 other establishments in Washington, I should say, where you decide what is transitory. The big mystery right now with Greg Vallier of AGF Investments is how do we migrate from 2.25 trillion down to whatever the number is going to be. Greg, do you see it as a negotiated tweak, or can there be a substantial markdown from 2.2564789 trillion?
I think it's a tweak, Tom. There will be some reductions. I think the Republicans will be 100% united, and I think at least one or two Democrats, obviously including the senator from West Virginia, Joe Manchin, will not agree to 2.25. I think the final number is going to be around 1.718, a mere 1.8 trillion.
I mean, you add it up. What is your response to people that add up stimulus 1, 2, 3, 4? The increase in the budget is established by victorious Democrats. What's your all-in stimulus number?
Oh, all in was probably 6 trillion when you include that last year. Yeah. It's that high. So you've got 6 trillion in fiscal. You've got a Fed chairman who basically is promising no rate hike. It's not a surprise this economy is about to blast off.
Greg, are you taking bipartisan talk seriously in Washington?
No, I don't think so. I think that there will be the pretense of bipartisan talks. They will say they want to get along, but Biden has very subtly changed his rationale here. It's not bipartisan among members of Congress. Yeah. It's bipartisan among the American public. And Biden is now saying that you've got at least a third of all Republicans around the country liking his prescriptions. That's where he says we now have a bipartisan consensus.
Greg, do you think he's moving the goalpost just a little bit to justify the lack of his ability right now to get the unity? Because that's what he campaigned on, that he'd been around for decades and he could get this done on Capitol Hill.
Absolutely, John. I mean, they are, I think, really nervous about the timetable. We've got another election, incredibly, in the fall of 2022. They know they've only got maybe 2 or 3 quarters to get everything done that they want, and then we just get into a campaign mode. So, yes, he's changing the goal.
Bit of a connection problem there with Greg Valliere of AGF Investments. Greg, just hold tight, sit tight just for a couple of seconds. We'll try and re-establish that connection, Lisa. That's the issue right now. They can't get it done on Capitol Hill in a bipartisan manner. You move the goalposts, you change the language, you talk about unifying the country and not unifying Congress.
Well, and then you talk about how much they want to get done in this time period in a unilateral standpoint, given the fact that they still do have to unify the Democratic Party. You know, one thing that Greg Valliere was saying in his note is that the sky is the limit, and it's not just this $2.25 trillion stimulus proposal. It's also the budget that President Biden put out there, and that basically you're actually seeing the budget being more than $100 billion more than the previous one without the infrastructure spending. Greg, I think you're back with us. I think we've got a better connection. There's a question here about what that means for inflation, and you said the red hot housing market is the canary in the coal mine. Please explain.
Yeah. Well, everywhere we go, I'm in California right now, if you see a house you want, you have to offer more than the asking price. You have to throw in an extra 2 or 3%. So we're seeing everywhere things are heating up. If you saw the Fed chairman last night, I think he's still very sanguine about inflation. I think he's wrong on that.
I got to say, John, this to me is one of the key issues we deal with every day. This question of the amount of money being thrown both by the federal government, regardless of whether they pass this $2.25 trillion stimulus, as well as the monetary support. Just how can this not lead to inflation?
It's not just about supply. It never is. It's about what you think that supply will achieve. That's true in credit. Where does the money go? If it's used for refinancing, that's maybe bullish for credit. If the supply issue in the United States is used to just cover a budget deficit, you've got a problem. Right now, Greg, the supply is being used to generate a boom in economic activity, and hopefully a boom on the supply side as well. Greg, why do you disagree with the chairman of the Federal Reserve on this transitory word, on this hot button issue?
You see bubbles everywhere. I think, number one. Number two, I feel strongly that by the end of the year, unemployment will be a little under 5%. That's getting close to full employment. And I think the Fed has to acknowledge that once you have full employment, that could begin to percolate wage pressure.
Whatever they think full employment is, Greg, that debate is still ongoing, sir. Greg Valliere, AGF Investments Chief, US Policy Strategist. And I think, Tom, on that final issue, that's probably the issue right now. This Federal Reserve is talking about substantial progress towards their goals before they make a move on, say, the balance sheet, on tapering, on the expansion of that balance sheet, to be more specific. What is substantial progress, Tom? What is it? Because right now they haven't defined it. And I think, like others, Tom Borselli of RBC was on this show with us on Friday, that's a feature of the communication right now, not a bug, that they're taking advantage of how vague they're being, because right now the market is on the same page. That can change in the next several months. It can
change in a heartbeat. It can change in one report. This is so important that everybody's on the same page of mystery, and all of a sudden there's no mystery, and you're going to get a data stream in, and then you start setting up those benchmarks of when do you go. I'm looking at wage inflation as the ultimate mover to move from transitory.
Yeah, do you know what I'm looking at, Tom? Labour shortage.
Yeah.
And whether the supply will be held back because of the entitlements that we've seen.
But didn't we have labour shortage
in the last 12 months? We did, Tom, to some degree, but they think they could have burnt hotter. This time around, you've had this massive effort on the fiscal side to help provide relief to people who haven't been able to go and look for a job. They can look for a job now, Lisa.
Right.
And I think the conversation at the moment, and I don't have a view right now, but it's a debate worth highlighting, is whether those people start to look for a job in the next several months.
And actually, there has been academic research that points against the idea that people aren't going because they're getting income. But honestly, the question of slack in the labor market, a real big mystery right now, John.
Bill Dudley, formerly of the New York Fed, he'll join us next on this program, on radio, on TV. This is Bloomberg Surveillance.
Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
60 minutes away from the opening bell in New York City. Let's get to work. Equity futures down around about 0.1% on the S&P 500. Down 6, no drama. On the Nasdaq, massive week of gains last week. 3.9% on the Nasdaq 100. Right now, Nasdaq 100 futures negative about 1/3%. The Russell unchanged. Let's switch up the board just quickly. Get to the bond market. 2s, 10s, 30s. We touched on credit a little bit earlier. Equities all-time highs. Credit spreads as tight as 3 percentage points less than that now, even with a ton of supply on the credit side. But as Barclays pointed out, and as Tony Rodriguez of Nuveen pointed out as well, 72% of year-to-date issuance in high yield for refinancing. Get your head around that. That's important. The biggest proportion of supply for refinancing since 2003, according to Barclays. That's the credit story. The Treasury story, lots of supply from the sovereign. Going into that, 10s, 3s, a little bit later, yields unchanged. Call it a basis point higher on 10s to 167, on 30s to 233. Let's finish on foreign exchange. Let's get to euro dollar. Maria Tadeo dropped me an email from Brussels over the weekend, our colleague and good friend. 500,000 daily vaccinations in France. In Germany, in and around 700K last week too. Record numbers. It's really important, and it starts to change the dynamic, the conversation around euro dollar. This time last week, 117 handle, right now 119. It's a good change, Tom. 119.14, euro dollar up on a session by 1/10%. The numbers in America are great, but the story is well known. The numbers in Europe are improving, and that could be the source of upside surprise in the weeks to come.
Something to watch here, and also, of course, what to watch was Chairman Powell's comments last night on 60 Minutes. John and Lisa, I know, want to speak to Bill Dudley about where we are now with the Fed. We make jokes about transitory, but it is shocking to see the fiscal stimulus that we have right now. William Dudley is a former Federal Reserve Bank president of New York, and buried last week in the news flow was his exceptionally important essay for Bloomberg Opinion on the banks in leverage. It harkens back to the summer of 2004, as codified by Simon Johnson in his book 13 Bankers, when the SEC allowed the broker-dealers to become more leveraged. Bill, this is not like 2004, where you say these are banks that need to be free from regulatory restriction.
No, it's completely different. Their balance sheet's becoming more tight because the Fed is buying Treasury securities and agency mortgage-backed securities, and that's boosting the amount of reserves in the banking system. The banks can't make any choice about whether they're going to hold the reserves or not collectively. So that as that amount of reserves in the systems goes up, the leverage ratios for these banks becomes more binding.
How is Bill, how is Jamie Dimon or other bankers, how are they restricted now?
Well, the leverage ratio hasn't bound very tightly for many banks, but it will become more binding as we go forward, as we go from now to the summer, because reserves in the system are going to go up pretty dramatically. What will happen at the big banks is they'll basically try to push deposits elsewhere. They basically won't want to take corporate deposits. They'll want the corporations to take their money elsewhere. That induces unnecessary frictions in the system for no net benefit. So it seems to me like it's pretty obvious that why don't you just make an adjustment for the leverage ratio to take into account the fact that the Fed is driving the amount of reserves in the system, not the banks.
How uncomfortable is it, Bill, to be arguing to reduce certain regulatory pressures on banks at the same time that we're dealing with the Archegos fallout that JP Morgan says will probably cost banks $10 billion?
Well, remember here, reserves at the Federal Reserve are not risky assets. So we're not talking about an exemption that increases bank risk. And if we're really concerned about the idea of, exempting reserves and that giving the banks more room, we can just raise the leverage ratio requirement from, say, 5% to 5.5% on what's left. The point is that reserves are not risky, and banks can't control how many reserves they hold. That's determined by the Fed.
Although moving beyond just this particular point of regulation, talking about the leverage ratio, you've talked before about concern about leverage building up in the shadow banking industry, about a lack of regulation in that particular area of financial markets. Do you still see this as a concern, and do you see it as a pressing one, or simply something to deal with perhaps later on?
I think it's pretty pressing. I mean, when you think about what happened last March, a year ago, basically the federal government had to rescue the money market mutual fund industry again. We had problems in the mortgage REIT space. We had problems in the corporate bond space. We had dysfunction in the U.S. Treasury market. So, and then more recently, we had the Archegos issues. So it seems to me like the non-bank financial sector is still rife with a lot of issues that need to be dealt with sooner rather than later.
Bill Dudley, I need to switch to the present Fed discussion. We've been making jokes all this morning about transitory as well. You and I have talked before about the British pretense of short-term, medium-term, long-term. Now we've got a transitory thing as we move along the x-axis in the timeline. Does any of this make theoretical sense, or are we just kidding ourselves, massaging the unknown?
Well, the Fed is being patient for a couple of very obvious reasons. Number one, they're not really sure where full employment is. Number two, they're not sure how fast inflation will rise once they get to full employment. And so they're willing, and number three, they're worried about inflation expectations becoming unanchored to the downside because the Fed hasn't been able to achieve its 2% inflation objective for a long time. So the change in policy is well motivated. The risk is that the Fed will be late. Before, the Fed basically tried to tighten monetary policy to arrive at a 2% inflation rate, full employment, and a neutral monetary policy all at the same time. Now they're not even going to start to tighten monetary policy until they're at full employment, inflation's at 2%, and they expect inflation to move higher. So the Fed's going to be much slower to tighten in this regime than in prior regimes, and that does create some risks for the economy.
But you say it's a risk that they'll be late. Isn't it a commitment that they're going to be late?
Well, the question is how late. Yes, I think they are making a commitment that they're going to be late. The question is really how late, and then how high will they have to raise short-term rates to basically keep inflation from continuing to accelerate. Now, the risk is, I think, that the risk is that recession will be more likely at that point, because the Fed's going to have to move not to a neutral monetary policy, but to a tight monetary policy if they're following this new framework.
So, Bill, this is a huge issue, and I think the most important question we can ask right now of Fed officials, and we asked it of Vice Chair Clarida on Friday, is how will they know if they're wrong on this transitory issue? If you were on the FOMC, back on the FOMC, Bill, how would you know if you were wrong?
Well, at the end of the day, I mean, I think they're going to look at the bubble that we're going to see in inflation this year as mostly due to base effects and some frictional costs as you sort of reopen the economy. They're going to be really focusing more on the labor market. How many people are still unemployed compared to where we were in March of 2020? Right now, we have a shortfall of employment of about 8.5, 9 million people, and the Fed's going to be tracking that very carefully. As those people get employed, then the Fed will start to not focus on the transitory factors driving inflation up, but really the one that they are most concerned about is at what point do you get to such a tight labor market that it generates wage pressures that drive up prices?
And Fed officials have said that they have the tools to combat inflation that's higher than expected. Do they have the tools to deal with financial disruption after this incredible surge in risk-taking that has been on the heels of Fed policy? What happens if that's stopped in its tracks as a result of Fed tightening policy?
Well, I think you're raising an important question that when the Fed goes from very, very friendly to unfriendly financially, I don't think the Fed cares about the stock market level per se, but they do care if the stock market were to collapse, and that would potentially hurt the U.S. economy. So the Fed does care about financial conditions in terms of how they feed into the performance of the economy. But the Fed's not going to run to the rescue just because the stock market goes down 10 or 15 or 20%.
No, but it raises a question about whether if the Fed is going to tighten in the near term because they see that things are getting a little bit ahead of their skis, or if they try to take actions to combat inflation, could they torpedo markets that are already at heady levels? I mean, do you feel like your colleagues are actively considering that, or is that sort of not as significant as just getting the market and the economy back up to speed?
I think Chair Powell repeatedly has made it very clear that the Fed's not going to be preemptive, and they're not that concerned about financial stability risk. What they're concerned about is getting that 8 to 9 million people back to work as soon as possible. That's the focus of policy right now. What that does do, though, creates a risk for markets when the Fed has to shift gears and start to worry about inflation.
Bill Dudley,
that's probably several years off.
In our great debate here, do we still underestimate that wage inflation doesn't move because of the new technological impulses that we see in our economy?
Well, that could be a factor. I mean, we're running an experiment, basically. We're running
well said. Well said.
And we're going to see how it goes. And this experiment is, has more uncertainty than usual because we've never had a recovery from a pandemic like this before, going back for more than 100 years. So anybody who tells you that they know how the economy is going to perform over the next year or two, I think is not being truly honest with you, because we've never had an economic recovery like this one, fueled by massive monetary and fiscal policy stimulus. So I think it's going to be very hard to know for sure how fast this is all going to unfold.
Before you go, Bill, an important question. Mohammed Al-Arian asked it on Bloomberg Opinion this morning. Did the Fed shift policy lanes at the wrong time? Do you think they made this framework shift a little bit prematurely? I asked that because I wonder if they had known what was about to happen on the fiscal side, whether they would have made this change.
I think they would have made the change in any case because they were really worried about inflation expectations becoming an anchor to the downside, and because they had such a poor record of forecasting what level of employment is full employment. So I think they would have made the shift no matter what. But I think Mohammed Al-Arian's piece is a good one because I think he points out the fact that there are some risks to this new strategy. The Fed could be late, and if the Fed is late, they'll have to slam on the brakes, and they'll have consequences not just for the economy, but also for financial markets.
Looking forward to catching up with you both on that issue a little bit later this week as well, Bill. Looking forward to that. Bill Dudley there, former Federal Reserve Bank of New York president, on some of the issues right now, and highlighting a really important one right now, Tom, too. This Federal Reserve is unwilling to risk being early, so they're committing to being late. And President Dudley, former President Dudley of the New York Fed, raising the important question, which is, it's not a matter of if, it's a matter of how late they will be and how much damage that will do.
It's just, to me, John, it's just a game. They're ex post. They're always after the fact. Now they're going more after the fact. And you're right. There's going to be a point where they're going to be after the fact. Yeah. And they're going to be, oops, we're late. We've seen this act before.
We have. We have seen this act before. We'll continue to discuss this act too with Kathy Jones, Schwab Center for Financial Research. The Chief of Fixed Income Strategist will be joining us a little bit later on Bloomberg TV. I'll do that in the next hour, Tom. So I'm going to run away as you get set up for the rest of this week. I'll be getting set up for the show in about an hour's time, 20 minutes time.
John Farrell, thank you so much as well. Joining us now, Anurag Rana with Bloomberg Intelligence, as we look at Microsoft going after one of the software providers for Siri. It's real simple. Nuance makes really smart speech recognition. They're going to be taken out. It's a small bolt-on for Microsoft, 1%, even 1% less of the balance sheet. Anurag, what's the why here? Why do they need to do this transaction?
So if you look at it, the pandemic has accelerated digital transformation across all sectors, healthcare being one of them as well. And I think if you look at the world today, telehealth is going to be a big deal. And in September, Microsoft announced a partnership with Nuance where their Teams product, which is their chat collaboration product, can be used by patients and doctors to interact. And this other software by Nuance will transcribe that conversation right there. So you don't need to take notes after the discussion. You don't need to send that video clip to anybody as you're talking. It's transcribing that conversation and saves it as a file for you to review later on.
So I can see this. Lisa, this is going to be great. You're going to turn to the software and go, take 2 aspirin, call me in the morning.
Well, I will say, having covered healthcare in a former life, that this would be a complete game changer for a lot of doctors who spend a good portion of their day transcribing every single meeting in order to make sure they have the right records. There is an obvious reason why Microsoft would want this. It would be their biggest acquisition since LinkedIn. Is there any antitrust concern, Anurag, at a time when both Democrats and Republicans in Washington are saying this is a concern?
So the fun part is, if it was any other company, I would have said yes. If it was, Google, Alphabet, or Amazon. But for some reason, Microsoft, when it buys a company like this with a tiny revenue base, this company generates about $1.5 billion in revenue. So it's not that huge. It's not growing that much. It's only growing 3 to 7%. So, from that point, I don't think so. But having said that, it's going to be fun to see how this administration takes a look at any acquisition right now in the market space.
Is this the beginning of a series of acquisitions for Microsoft? Because there have been other rumors in the recent past, discord among them.
Yeah, I think it's been around. I think we haven't seen that big of an acquisitions in the, anything from the larger vendors. But once again, think about it, why Microsoft is buying some of these companies or looking to buy some of these companies is to improve the functionalities of their own core products. This company has, huge ramifications, not just for the healthcare stuff that I mentioned, but imagine being able to order, your Office Excel to do work for you using voice commands. So, the technology is what Microsoft is going after. I expect not just Microsoft, others to be part of it as well.
Anurag, was this an offensive or defensive acquisition? Did they make this so Apple wouldn't buy them?
Oh, no, absolutely not. I think this is very offensive because in my view, they are investing a lot more in the healthcare cloud area. They have a product called Cloud for Healthcare, and that's a HIPAA compliant product that they expect other people to use it. As I said, healthcare is an industry that lags everything else. It's so behind retail, banking in terms of their ability to be more digital. And what we have seen because of the pandemic, you need to be digital. So we think it's going to be a big deal for the healthcare industry, and we expect more from here.
Anurag Rana, thank you so much. We'll have much more on this, particularly Bloomberg Technology this evening. Nuance taken out by Microsoft, a fluid time for many of the tech companies, huge equity gains, and also huge cash on the balance sheet. This is a conversation that we have wanted to have for days with the passing of Robert Mundell. You've heard me say to Ken Rogoff and others that the lineage of our international economics goes back through Chicago of long ago and Jacob Frenkel. We are thrilled that Dr. Frenkel could join us this morning. He is, of course, with a group of 30, chairman of the board of trustees. Jacob, we had a wonderful Friday with Ken Rogoff, Richard Clarida, and Angus Deaton talking about the 20th century international economics. When you were writing at Chicago, what did you learn from Mundell at Columbia?
Well, to begin with, when I came to Chicago in 1968, Mundell was a superstar. We were students together, Rudy Dornbush, Michael Musa, myself, and some other people who were all, in a way, hypnotized by the way in which he changed completely, the way in which the economic profession looked at the economy. I would say that up to that point, the world was viewed in the textbooks as a closed economy. Each country was a unit. Yes, it had some interrelationships with other countries through trade, but by and large, it was a closed unit ran by the policymakers of that unit. Came Mundell and said, the only closed economy for real is the world, but each country within the world is interconnected. And therefore, in order to understand how the economy works, we need to develop a new approach, which is called open economy macroeconomics. It means that you cannot run monetary policy under the assumption that you are a closed unit because, after all, the exchange rates...
Let me, because of time, and I know Lisa wants to get in here, I want to drive this forward to the modern age, because you, with your work with J.P. Morgan, with Mr. Diamond and the team there, and your work with Group of 30, you have been the architect of so much of our discussion of an open economy. As Mr. Diamond mentioned in his letter the other day, does America have a chance to lose our open economy advantage?
It depends if it keeps the open economy perspective or if it closes itself. The only way a country can succeed, small or large, in the integrated world is by being open, to benefit from the better things that other countries do, and to benefit other countries by the things that we do. The principles of comparative advantage that were coined still ages ago by David Ricardo, Adam Smith, are still valid today, but even more so, because capital markets are very interrelated. Capital markets are moving by expectations. Expectations are being fed by announcements, and announcements are affecting the economy through the credibility. All of it together means that we cannot afford playing the game of isolationism. And anyone who will try to do it will be penalized by the markets. And I believe that by now there is greater understanding that when countries are trying to close themselves under the excuse of trying to protect its own citizens, so to speak, as a matter of fact, they hurt their citizens because they don't allow the citizens to enjoy the benefits from the rest of the world. Knowledge and technology are shared.
Jacob, this used to be a common thought, a common belief, and increasingly it's become less so, and there's been more isolationism. I'm wondering how much pushback you're getting, even from the members that you talk with among the group of 30, to this idea that perhaps globalization doesn't help everyone in the same kind of ways, and that certain things need to be done in a more domestic capacity, especially as we see these supply chain disruptions.
Absolutely. But the main lesson is not to throw the baby with the water tub. Namely, if globalization is not perfect, don't make globalization a passé. On the contrary, ask yourself, what's not working? What was not working was that the benefits were not widely shared. And this is basically the agenda for governments to make sure that the benefits are widely shared. That's the essence of fiscal policy, of transfer payments, of tax policy, but it is not the case against opening the window. If you open the window, yes, you may get some storms, so make yourself more robust. But if you close the window, you really miss the smell of roses from the garden.
Are the benefits from globalization the same now as they were 20, 30 years ago, given how much pay has evened out, given how much wealth has gotten spread out around the world? We don't have a same China today as we did 30 years ago, driving prices down.
30 years ago, we did not know that China will come, and here it came. And you could have said 30 years ago that globalization has already exhausted its benefits. By the same token, today, when you look today at we have experienced now the pandemics. We have experienced now the fact that pandemics did not recognize borders, that knowledge is an international public good, that the vaccinations are to be shared, that the mechanisms need to be in place. So by and large, the manifestation of globalization will come from different places. In the coming year or years will be in the health area, in the climate area. We need to have the cooperation and coordination for issues that do not recognize borders.
Jacob Frankel, it is such an honor to have you on right now. As Adam Posen of the Peterson Institute announced the death of John Williamson. I'll be honest, Jacob, I can't think of someone I better talk to at this moment than you. John Williamson was a microeconomist who spanned all of economics, including macroeconomics, and his founding in 1989 of the phrase, the Washington Consensus. Jacob, every bit of your work identifies what Williamson wrought. Do we have a Washington Consensus today in honor of John Williamson?
Well, to begin with, I really want to share Adam Posen's sadness and sorrow and with the death of our good friend John Williamson. The Washington Consensus was a concept that was developed about the notion that there was a consensus of what does it take to be a successful economy. And I believe that today we do not have the Washington Consensus. And the reason is that especially since the great financial crisis of 2007, 8, 9, subsequently with the subsequent crisis, seems to be that policymakers in many places of the world have, I would say, lost their compass. And if you lose your compass, you cannot have a consensus about a strategy. And I think that the challenge today is, again, to recognize what are the basic principles that are robust and what are the things that can be pushed aside. And I think that consensus can be held. I still think that the issue of globalization, of openness, of making sure that globalization succeeds, of making sure that the benefits are shared, of making sure that the machinery is in place to bring about this sharing of the benefits. This has to be a strong fiscal system, a strong tax system, and a very independent, focused monetary policy looking at the long term and not just about the short term.
Jacob,
Mandela,
we have
the discussion about Mandela. He was a far-sighted economist that could see behind the corner And therefore, it was so successful.
On Mundell, on Williamson, Jacob Frankel, we are so honored to have you with us, the former governor of the Bank of Israel. Lisa, we get so fortunate sometime with when we have our guests on. Lisa, I thought what was fortunate today, and this is a rare occurrence, we saw a lot of positive tone on equities and on the price of fixed income.
This is a faith-based market. This is a faith-based market that we're not going to get serious inflation that is beyond transitory. It will be transitory. That is the belief, and I'm going to try to see how many times I can get you to drink before the end of this show. And you just toss that cup over your shoulder for all the people who are listening on radio. But this really is the idea here. People believe in a bull market without the inflation that so many people are worried about that could kill it.
That is the setup for this morning, and that setup will be tested by the economic data. We'll have that less for you today, but much more through the week with inflation and retail as well. Futures -5, very much stable, barely off that surge that we saw on Friday, the VIX 17.06. Coming up, the gentleman from St. Louis, James Bullard of the St. Louis Fed. Please stay with us on radio and television on this Monday. This is Bloomberg.
Madame Lagarde, has the balance of risk actually shifted since the last policy meeting?
Well, our balance of risk is still tilted to the downside in the short term, but it is much more balanced in the medium term.
What are markets exactly playing out at the moment? They seem to be continuing testing central banks.
They can test us as much as they want. We have a mandate, we have an aim. We're going to be riveted to that, and we're going to do what is required.
I have asked the Securities and Futures Commission and the Hong Kong EX to work together to explore the viability of our own Hong Kong version of SPACs. We remain very confident on the competitiveness of the Hong Kong stock market.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Huge week ahead from New York City for our audience worldwide. Good morning, good morning. The countdown to the open starts right now. With 30 minutes to go, equity futures negative around about 0.1%. Let's get straight to it. We begin with the big issue. Can the data meet high expectations?
There's very lofty, mature expectations baked in.
The second quarter is a turning point.
The key here is not just the earnings season.
As we progress into the second quarter,
does the data continue to exceed expectations?
Everybody's freaked out about short-term data.
The risk, of course, is that we get higher inflation.
The prospect of rising and sustainably higher prices.
As the earnings reports come in,
a lot of it depends on cost.
There's going to be a lot of noise coming through the inflation data.
Earnings need to be strong.
We look at expectations.
The concern is if the liquidity paradigm changes.
Everybody thinks that a little bit of inflation and higher rates are going to end the party.
This is going to be a market sentiment issue.
Let's bring in the Bloomberg team, Kaylee Lyons and Abigail Doolittle. Kaylee, the bar is high, high, high.
The bar is very high, John. The consensus seems to be that things are looking up. You have trillions of dollars in fiscal spending working its way through the U.S. economy, and you also have COVID-19 vaccinations working their way through the population. To this point, 87 million shots have been given to Americans. Right now, at least a third of them have received at least one dose, and a fifth of the population is fully vaccinated. And if we keep up the current pace of inoculations, it will only take another 3 months to cover 3/4 of the population. So that helps speed up the reopening of the economy. And when you layer on top of that the stimulus story, it all adds up to higher growth expectations. On average, economists tracked by Bloomberg expect in the first quarter the U.S. economy will be higher than the year prior for the first time since the pandemic began. And for this current second quarter, economists expect U.S. GDP to jump 12.2% on a year-on-year basis. Of course, that's after the economy shrank by 9% in the same period in 2020 at the height of the lockdown. And with that better economic growth, the corporate earnings story looks to be picking up as well. If we can hop into the terminal at GTV Go, take a look at the white line that is U.S. nominal, or the blue line, excuse me, is U.S. nominal GDP. The white line is forward sales estimates for S&P 500 companies. Those two lines essentially track each other. The S&P 500 is expected to post 6.1% revenue growth in the first quarter of this year compared to last, which would bring revenue to an estimated $3.16 trillion. That is just shy of the $3.22 trillion in the fourth quarter of 2019. So we would be very close to erasing all of the pandemic losses, John.
Kelly Lyons, thank you very much. They are the expectations. Can we meet that very high bar? For more, let's bring in Abigail Doolittle. Morning, Abby.
Good morning, John. Not surprisingly, with that sales recovery that Kelly was just outlining, the expectation is that the bottom line will improve too. And of course, in the fourth quarter, we did have modest growth, ending the pandemic earnings recession up 2.3%. But the big growth this first quarter is expected to be 19%, but again, a high bar. And then the second quarter, take a look at that, 50% year-over-year growth for earnings. Now, of course, the comp from the previous years is very easy, but nonetheless a high bar. But that's the quarter that everybody is indeed looking to. In terms of small cap, though, the recovery and the idea of froth too far, too fast, that's come into play just a little bit because, of course, the small caps were just rallying in a huge way at the end of last year into this year on the idea of the reflation trade. But more recently, some folks are a little bit worried. So we have the Russell 2000 underperforming the S&P 500 by about 5% since the beginning of March. The realization that what's been working may continue to work. In other words, those big tech stocks. And then finally, John, if we take a look at our last board, we are going to see the airlines leading the Dow Transports to a 10th up week in a row, really a recovery there, the longest since 1989. It is going to be interesting to see, though, whether or not these companies deliver as earnings start to roll in this week with the big banks.
Abby, thank you. In many ways, the year starts right now. Since the end of October, early November, when we got that first headline across the Bloomberg terminal about vaccines and the optimism got a ton of fuel for the year ahead, this is what we've been waiting for. Inflation data tomorrow, earnings on Wednesday, retail sales on Thursday, and retail sales is set to be huge in America, month on month, this coming Thursday. Economist Peter Cheer has two important questions. He writes the following, quote, "The question isn't whether or not we get an economic boom. It's one, how big will the boom be? And two, how long will it last? I'm increasingly concerned too much is already priced in." Morgan Stanley's Mike Wilson has his own warning. He writes the following, "We're now seeing evidence of supply shortages in everything from materials and logistical support to labor. The punchline is that 1Q earnings this season may bring bad news on costs and margins, particularly with respect to 2Q outlooks." Joining me now is Kathy Jones at Charles Schwab. So Kathy, let's start with the Peter Cheer point if we can. How big will the boom be, and how long will it last?
Well, given that we have really expansive fiscal policy and really easy monetary policy, I think the boom lasts a while. Now, a lot's priced in, but it's hard to make a case that we're going to have just a flash in the pan unless the Fed starts to tighten policy or some other exogenous shock comes up. So, you know, the strong economic data is likely to last all year.
The data on Thursday is going to say that. March retail sales explosive, Kathy. We could see it through the year, I agree. But we're going to have this conversation increasingly about costs, input costs. So here's the Morgan Stanley line. The earnings season might bring bad news on costs and margins, particularly with respect to 2Q outlooks. Where are you on that debate right now, Kathy, on costs, on input costs, and on margins for corporate America too?
Yeah, I think margins probably have hit peak levels or are hitting peak levels, and will get squeezed with the rise in some costs. But we look from a corporate bond perspective, we look more at the cash flow, and the earnings are still strong, the cash flow is still strong. So when we look at companies being able to meet their requirements in terms of interest payments, we're not too concerned about it right now.
And when it comes to credit, Kathy, I think another important dynamic, and we mentioned it in the previous hour on TV and radio, the amount of supply we've seen is one thing. What that supply is used for is critical. 72%, according to Barclays, of that supply year to date has been used for refinancing, Kathy, on the high yield side. How important is that dynamic?
Oh, absolutely critical for high yield. I mean, some of these companies have termed out their debt to as long as 10 or 15 years, which is practically unheard of in the high yield space. And they've rolled over debt into lower cost debt because the market's been so eager to get yield. So it's been critical for some of these companies. The lower credit quality, the better it is for them if they can refinance at low rates. So we've seen like triple C's outperform everything else because they've been able to refinance.
So, Kathy, here's the challenge. For the equity investor, equities are already record highs. For the credit investor, spreads are already through the previous cycle's tides. And now we're going to start to see the economic data in the next couple of weeks. Kathy, what does that mean for how you set up for the boom that you think can last all year?
Well, first off, is short duration. That's first and foremost because we do see yields moving up and the curve continuing to steepen. Beyond that, we're neutral on credit, corporate credit, just because so much is already priced in. We don't see it deteriorating. As you see, spreads can spend a lot of time bouncing along at tight levels until something changes. The way we're trying to play it is with emerging market bonds, and we still see some room for appreciation there as the global reflation trade takes off, and we think that that's an opportunity.
Kathy, stick with us. We'll talk more about this, and I think this is an important conversation beyond the US. Where will the source of upside surprises be? Where will it come from? Europe, emerging markets? The expectations for America are already sky high. I went through the estimates from Bank of America a little bit earlier this morning. I'll do it again right here, right now. We expect the March retail sales report to be outstanding, with headline and core retail sales both surging more than 11% month on month, not year on year, month on month. These are phenomenal numbers we could get this coming Thursday on the spending side. Let's get you some movers. Equities are doing okay. It's a mild move back from all-time highs that are closed on Friday. With your movers, here's Abby.
John, we of course have had some breaking news over the last hour, and that is the fact that Microsoft is buying Nuance Communications for nearly $20 billion. Nuance had been halted, but now higher, popping, soaring, up 20%. Microsoft basically flat, and this of course is a big bet on healthcare, this artificial intelligence in healthcare, telemed, a transcribing service. So Microsoft making a big bet on this, and it will be their largest acquisition since LinkedIn. Turning to other movers, we have little movement for one part of the reflation trade, lots for the other. JP Morgan and Bank of America up just slightly, with yields up ever so slightly. Where we have a bigger recovery, though, of course, John, is oil back above $60 a barrel, and big oil trading higher with oil. So it seems today, at least, at this moment, the reflation trade is back in gear.
Abigail Doolittle on a crude story as well. Incidentally, Bank of America pulling back on their crude call for the third quarter, I think. We'll touch on that a little bit later. Right now, equity futures, 41.14 on the S&P 500. UBS had 4,100 year-end. Goldman Sachs has 4,300 year-end. That was their number coming into 21. And right now, 41.15 on S&P 500 futures. It's a mild move back from all-time highs. Coming up, a monster week ahead. Inflation in America, CPI tomorrow morning. That conversation up next with Charles Schwab's Kathy Jones, and dropping by Neuberger Berman's Ashok Bhatia, looking forward to that. From New York City this morning, good morning. Equities, they open 20 minutes from now. Futures right now, down 5 points on the S&P 500. Negative a little more than 0.1%. For our audience worldwide, what a week we've got coming up for you stateside. This is Bloomberg.
Asia is absolutely core to our business. It's almost 20% of our franchise revenues globally, which is significantly more than most of our global peers who are more in the mid-teens.
We want to invest, grow in China, but also we are also investing in the rest of Asia as well. Our top line growth for the region has been close to 24% last year, almost 20% of the group's revenue as a percentage of the revenue of the group. So, and this is where the group is counting on the growth.
We see company after company, these are corporates committing to net zero. So pretty much across the board, there is an enthusiasm for putting capital to work to try to get us to a better carbon future.
Credit Suisse has a fantastic brand name in Asia. We have obviously strong positions in Singapore and Hong Kong as our two main hubs, but across the region.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
What we're seeing now is really an economy that seems to be at an inflection point, and that's because of widespread vaccination and strong fiscal support, strong monetary policy support. We feel like we're at a place where the economy is about to start growing much more quickly and job creation coming in much more quickly. So the principal risk to our economy right now really is that the disease would spread again.
Fed Chair Jay Powell sticking to script on CBS over the weekend, pledging to maintain support amid improving U.S. economic data. Vice Chair Clarida doing more of the same, discussing a key shift in the Fed's framework.
Our goals are maximum employment and price stability, and we want our policy to be robust if our models break down. And we can still do monetary policy, but we're going to be more outcome-based and less outlook-based. And I think that served us well in the pandemic, and I think it will serve us well in the years ahead.
Let's bring in Michael McKee for more, our international economics and policy correspondent. Morning, Mike.
Good morning, John. Well, I'm going to paraphrase myself and say this week comes the data that you are looking for. Buckle up those bond market seat belts. The pandemic hit the U.S. economy hard in March, April, and May of last year. And as a result, this week we get a lot of screwed up numbers, and how the market interprets it will be important.